got it. I mean, whether or not the cognitive issues are real or not, he's going to have to demonstrate that and continue to demonstrate that. Just what the Attorney General did last week in taking a non-privileged conversation and trying to assert executive privilege over it shows you just how sensitive the White House is to that, and it actually, in a backdoor way, sort of validates it.
Hypersensitive. Terry, thank you, sir. Terry Haynes there of Pangea Policy. The latest polls, not great. The latest one around Arizona, not tremendous either.
Arizona and around Florida, and the whole idea here was that potentially abortion would be on the ballot for Democrats. But the issue we're seeing at the CBS poll over the weekend, when it comes to Arizona and Florida, is that actually there's more concern about inflation, the economy, and also immigration.
How does he turn that around, Bramo, between now and November?
I don't think anyone knows. I think he's hoping the debates will do something to try to draw some contrast with the former President Trump. I thought this poll was really interesting. An NBC survey last month found that interest in the election is at an all-time low ever since going back to 2012 and had declined since September. So people basically are looking at this and getting less and less interested and more disconnected.
The hope of the president is that as we get closer to November, they become more interested and they lean towards him, which is one of the reasons, I think, why they were pushing to get that first debate in early June.
They wanted to come back into the households of the American people. They wanted to be on their TV sets. They wanted to remind, I think, the American people of some of the rhetoric that you saw a lot of independents really have issues with when it came to the former president. So they're going to move up that debate because the numbers are showing that Biden has to get out in the public and make his pitch.
That's the latest on Washington and the Middle East. Coming up on this program, big moves in the commodity market. Gold and copper surging to all-time highs. Kona Hack of ED&F Man joins us next from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Equity Futures here, just about positive to kick things off Monday morning. Good morning to you and welcome to the programme. On the Nasdaq, we're positive by 0.2 following 4 weeks of gains on the S&P, on the Nasdaq and on the Russell too. Looking out for NVIDIA on Wednesday. Price target upgrade coming out of Barclays this morning, 1100 from 850. All signs still point to another revision higher. How many revisions higher have we had from NVIDIA over the last 12 months?
That's been the story of why we've seen its valuation triple in the past year. I mean, this has been a moonshot and could really direct a lot of the approach of the entire market, the tone of the entire market. But what I find interesting is what you've seen under the hood is, yes, you've seen some of the big tech names regain some of its dominance, but you haven't seen the momentum trades take off in the same kind of way. There has been a shift under the hood in the rally that we've seen.
NVIDIA up in a pre-market by around about 1% so far this morning. Let's turn to the bond market, 2-year, 10-year, 30-year. 10-year yields down for 3 consecutive weeks. We've been pulling back over the last few weeks. Your 10-year at the moment, 441.79. On a 2-year, Lisa, 481.80. Light on economic data, I think AMH called NVIDIA the data point of the week, and I think a lot of people, even in bond markets, might agree with that.
The fact that people are talking about the Fed's meeting minutes from the May 1st meeting tells you all that you need to know. The fact that that's the big data point, I think NVIDIA, I think it's fair to say, will probably be better than that. I will say, just taking a step back, there's a real question of how far the Goldilocks can go and whether the couple of softer than expected prints economically and a Citigroup Economic Surprise Index that's been falling and at the lowest level in about a year, whether that speaks to true disinflation that's sticky or whether this is just sort of another head fake. That disagreement you can feel in all the notes over the weekend. People are not on the same page with that.
Take those lower yields. Lisa mentioned that surprise index as well. Take the data relative to the estimates, and you've got a weaker dollar against the euro. Last week on the euro against the dollar, this currency pair, biggest weekly gain since March. Lisa, close to 109, 108. 74.
All of a sudden, maybe the disinflation narrative is coming back, and at the same time, you have a European central bank that even the hawks are coming out and talking about the potential for a June rate cut. I wonder how far this goes. How many notes did you read over the weekend talking about emerging markets as this new bet and this sort of reflation trade? Again, a lot of crosswinds. It's early days, and I think Kit Jukes and the angst that he puts out every morning really sort of solidifies it, where he's saying basically every day, don't get too excited. It's not going to get that exciting. Every single day, maybe we could talk about a new trend, but nope, not going to do it. Seems to be where we're at.
It's a challenge to peak exceptionalism. At least we're asking that question. And Peter Chi of Academy has been fantastic at that. Under surveillance this morning, your top stories, this out of Iran. President Ibrahim Raisi killed in a helicopter crash on Sunday. His death, along with that of the foreign minister, was announced by state media early this morning. Raisi was widely seen as a candidate to become the country's next supreme leader. And Anne-Marie, we're working out who's next.
Well, that's the big question. It's less so who takes over as the president. It's more so who's in line to be the next supreme leader, which really is the decision-making power within Iran. And the thinking was always it was between Raisi and Ali Khamenei's son. And now with Raisi's death, it does seem like potentially the one individual that could take over for Khomeini, who is 85 years old, is going to be his son. The tricky part of that is that Iran never wanted this to happen. They overthrew a monarch, and then they would be going back to that. So that is a very tricky frustration. Potentially, we could see some of that tension.
That's the medium to long term. Can we talk about the short term, just operationally, how things are set up now? The RGC reports to the supreme leader, so who oversees the military is not going to be affected here. It's going to be, what, 50 days before we get another election, and in between we get the vice president?
Vice president. So if you look at Article 131 of Iranian's constitution, which I did over the weekend, and then Khomeini came out and said, we will follow this. You have the vice president that will have a caretaker government, and then within 50 days, they will call for an election. But to Jumana's point earlier, you had Raisi standing alone in that election. So, quote unquote, an election will be taking place the next 50 days.
Much more on this story coming throughout the program. Any additional headlines, of course, we'll share that with you. Here in the United States, focused on the central bank, the Federal Reserve, plenty of Fed speak on tap today. We're going to hear from Bostic, Barr, Waller, Jefferson and Mester. Later this week, we'll also get the Fed minutes as well, weekly jobless claims and the UMich Consumer Sentiment Survey. When you are light on economic data, Lisa, I think you always run the risk of putting too much emphasis on the data that we will get. And that data is very light this week.
I would say the fact that you said University of Michigan sentiment survey, and then you started to warn about the unreliability of this data. I just want to point, it is shifting from 100% phone to 100% online. So if you thought that it was unreliable before, excuse me, it might be getting even more so. I agree in terms of where the mood is shifting. That said, I do think ongoing commentary from the likes of Macy's and Lowe's and Target this week, even though those are maybe second-tier names and the second-tier data points, will give us also some color in the consumer following on what we heard from Walmart, and whether that downshifting, that Walmart's gain is everybody else's loss, as we've talked about.
Michael Gapin is talking about the minutes, though, this week potentially being important. He says the May FOMC meeting should sound more hawkish on the margin than Chair Powell's press conference. So potentially we get a little bit more insight into what they were thinking.
I am always wondering just how dovish Chairman Powell is on that FOMC and how much distance there might be between him and everyone else on the committee. And maybe that starts to sort of dance a little bit on the FOMC minutes stage a little bit later this week.
To your point, every single time there is a Fed meeting, everyone says this is Powell's chance to push back against the market, to tighten financial conditions, to get inflation under control. And every time, he just can't help but do a dove. Like, he cannot help but be a little bit more on the dovish side. And that, to me, speaks to your point. Is he more on the extreme dovish side, where he really wants to nail the soft landing and solidify his legacy as really achieving what a lot of people thought was impossible?
He's got one gear, and he's stuck in it, and he was stuck in it in the last news conference as well.
Maybe he has another gear?
Oh, other gears?
Yeah.
Okay, I'd like to see them. Let's see if he has any. Let's turn to this story. Gold and copper surging to all-time highs. Copper topping 11,000 a ton, extending a months-long rally driven by expected supply shortages, and gold hitting a record high boosted by increasing optimism. The Federal Reserve will start easing monetary policy this year. Joining us to discuss is Kona Hack of ED&F Man, joining us out of London. Kona, let's talk about copper first, and then we can talk about the broader commodity complex. What is happening with copper? How much of this is just speculative frenzy, and how much of it is real fundamentals driven by a lot of demand and not much supply?
So copper has been a darling for a while. I mean, a lot of research houses, banks, hedge funds, mining companies, you name it, they've all been talking up the fundamental bullish fundamental stories of copper. And then that's slowly been gaining interest, and you've started to see a lot of speculative money coming in. And today, short term, you're seeing a huge influx of investor money coming in. The longer-term fundamentals are still there, still yet to be borne out, to be honest. But I think the momentum is definitely building out, and now you've got the momentum and the systematic traders that are coming in. So I think it's become a bit of a frenzy right now.
So basically, if I understand what the answer was, Kona, basically right now the momentum has further to go, but fundamentally things haven't changed. And even though things are good, they might not be as good as some of the speculation is driving it. Am I characterizing that correctly?
Yeah, I think, the story about mining issues, the fact that the supply is not nearly as enough as it should be happening, considering how big the ESG demand for transition metals is expected to be, that's all going to happen in the future. Today, the story is still China, where demand is lackluster. There's a lot of demand for the new economies, sort of the transition metals. That sort of thing is definitely boosting. But I think in terms of construction and real estate, that demand is still very lackluster. Premiums in China are still very weak. Inventories are low at the LME exchanges, that's true. But I think short term, it's more about the investor frenzy in anticipation of the longer term fundamentals.
Our own columnist, Javier Blas, would agree with you, and he put out a great column about this that I recommend everybody read. I'm wondering, Kona, if there's a similarity, if there's a rhyming between what's going on in copper and what's going on with gold, hitting yet another record and really continuing to climb. Is it the same kind of tenor in terms of what's driving people to both of these metals, or is it different? Is there something more sustainable in one versus the other?
So gold is definitely a bet on the fact that the Fed is probably likely to cut interest rates at some point this year. That's obviously weakening the US dollar, and I think that just lifts all commodities, generally speaking. So that's the two things I'd say is in common to both copper and gold. But gold today is benefiting from safe haven demand, given the fact of Iranian president dying and the ongoing geopolitical tensions around the world. So I think that's definitely boosting gold. I think going forward, where the two go, I think gold potentially has higher to go, particularly if you are a dollar bear, and you would be a dollar bear if you think that interest rates are going to keep on weakening. I personally do not necessarily think the Fed needs to cut interest rates. I think the U.S. economy is running pretty hot, so I think they can just hold, to be honest. And I think if we start getting data coming out of the U.S. economy suggesting that it's still very hot, and therefore the Fed may have to delay it in any rate cuts, I think that could then weaken the gold rally to a certain extent. But I think going forward, I think geopolitical tensions are here to stay for a while. I think that could be supportive. And I think copper has the whole environmental story and the supply side mining slowness there in response. I think that's also potentially supporting copper.
How much do you think gold's rally has been down to U.S. sanctions policy?
Could you repeat that?
How much do you put credence on that what some are saying there's a rally in gold due to U.S. sanctions policy and the concern about not being able to trade in the U.S. dollar?
Oh, it's a tricky one. I mean, yeah, I think ultimately sanctions, policy, geopolitics, they all have an impact on safe haven demand. I think gold is always going to be a good bet as a hedge against any of these uncertainties. So I think to a certain extent that definitely does have an impact. But I think today it's really still very much a US dollar bet, the fact that in the short term the dollar is expected to weaken. And I think central bank buying is definitely going to support the gold prices. And, you know, it's just fundamentally, it's more of a currency compared to other typical commodities. And I think supply-demand fundamentals are not something you can really use to analyze gold. So it really is your view on the geopolitical situation right now.
Kona, appreciate your time today. Some big moves in the commodity market. Just getting some breaking news. An update to guidance coming from JP Morgan ahead of their annual investor day. Here are the new numbers. Full year net interest income. This is the outlook. About $91 billion US dollars. They had seen previously about $90 billion. Let's just go through the pre-market price action for you and look at what's happening with the stock in the pre-market. We are just about positive here, Lisa, by 0.6%.
They also talk about $1 billion increase in their total cost, but that's because of a donation that they made to the JP Morgan Chase Foundation at a time where they are significantly increasing some of their revenues. There's also this line that tailwinds from 2023 are likely turning into headwinds, and I do wonder how much that has to do with some of the extra interest they have to pay depositors to keep some of their money. Because if you've noticed, we've gotten a lot of messages from our respective banks saying, by the way, I can offer you this savings rate, I can offer you this CD. I have never gotten so many of these before, and the pace at which I've been getting them has been really significant. So how much does that become a bite into how much they can kind of capitalize on higher rates without
Or
passing
they do
along?
that thing that really annoys me where they set a target for how much you need to have in your account and then you get a bonus.
Oh, yeah.
So not an interest rate over a period of time, just sort of like a cash bonus for keeping it there.
You mean if you have, you know, a certain incredible amount that's way over the FDIC limit?
You're not going to save it precisely.
Yeah. Then basically you can get extra $2,000.
Thanks a lot.
Yeah.
Awesome.
Sure.
Just great. Appreciate
And
that.
a pen.
So latest on the banks, a pen too. Tom would always talk about a toaster.
Well, that was a thing.
No toasters.
In the 1980s.
We're going way back.
Yeah.
No
I got
toasters.
stickers too when I opened my first account at age 11.
Good stuff. I'm sure you'd prefer 5%.
At that point, probably stickers were just fine.
Okay. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. One of Wall Street's most prominent bears has just capitulated. Morgan Stanley's Mike Wilson now sees the S&P 500 up 2% by June of next year, boosting his target to 5,400 from 4,500, which would have been a 15% tumble. Wilson and the Morgan Stanley team say that they expect a sunny macro environment, but Wilson did reiterate his view that outcomes are becoming harder to predict with volatile data. He had said last month that he was steering clear of big calls given that economic uncertainty. You can hear more. Mike Wilson is going to be joining the surveillance team at 8 a.m. Eastern tomorrow. Now, the ship that destroyed Baltimore's Francis Scott Key Bridge is set to be moved to nearby docks today. 18 hours of preparations to move the Dolly container ship began yesterday. Officials are going to be using several tugboats in a so-called refloating operation. It's expected to take 21 hours to do. Transit begins at high tide. The Dalian crashed into the bridge after leaving the port of Baltimore in the early hours of March 26. Manchester City were crowned champions of the English football's Premier League for a record 4th consecutive year. It was a 3-1 win over West Ham on the final day of the season, and that sealed their title win. It's a 17th trophy for manager Pep Guardiola at Man City, and that could become 18 next weekend when they meet crosstown rival Man U in the final FA Cup final. And that is your Bloomberg Brief, John.
Danny, thank you. I think I'll say it through gritted teeth. Congratulations, Man City again.
Oh, that was
and
so...
clip this for next year, the year after.
Exactly, that's the point.
After.
Doesn't it get boring after a while?
Someone tweeted over the weekend, what US franchise would you compare this to? The Warriors, Brady, and the Patriots, or Lance Armstrong?
The New York Mets.
And the Tour de France.
The Mets, come on.
I don't know, or the Jets.
Didn't they all miss that Lance Armstrong reference?
I got
there?
that, I got that. They're doping, or they're like, you know, I got it.
Well done, Brammer.
Anytime.
Up next on the programme, Rethinking 2%.
We all talk about wanting to go back to 2%. Every single quote you had this morning assumes that 2% is the right inflation target. 2% is totally arbitrary.
That's next on the programme, live from New York City. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Sports chat didn't stop in a commercial break, and let me tell you, it was just as dreadful in the commercial break as it was when we were live.
It wasn't dreadful.
Ago. It was pretty bad. Equity futures on the S&P positive by 0.1%. Yields unchanged on the 10-year, 441.79. Under surveillance this morning, rethinking 2%.
We all talk about wanting to go back to 2%. Every single quote you had this morning assumes that 2% is the right inflation target. 2% is totally arbitrary. We should all realize that if we are pursuing the wrong inflation target, the risk of a mistake, and that mistake would mean sacrificing growth unnecessarily, the risk of that mistake is high, especially when the low-income people are most at risk.
Here's the latest this morning. Plenty of Fed speak on deck today, including Barb Waller-Jefferson and Atlanta Fed President Raphael Bostic sitting down with Bloomberg's Mike McKee in less than an hour. Abigail Watt of UBS writing, quote, "We expect the general message remains of needing to wait longer than previously assumed before beginning to dial back restrictiveness." Abigail joined us now for more. Abigail, we're light on data this week, heavy on Fed speak. What would you be looking for from Fed officials as they communicate to the general public?
Yeah, first off, thank you for having me join today. I think the main thing this week is thinking about those speeches where the Fed speakers are going to be talking on the economic outlook, and in particular those speakers that are in the Board of Governors. So first off, as you said, we've got Vice Chair Jefferson speaking today, and he'll be speaking on the economic outlook and on house prices, and then we'll have Governor Waller speaking on the economic outlook on Tuesday. And I think the way that FOMC members are digesting perhaps some of the better news that they saw in the April inflation data last week, and how they're balancing that versus, I guess, some of the disappointment that they've obviously referenced through Q1's inflation data. I think also of note will be Governor Waller's speech on Friday, in which he's going to be talking about R-star. We've written recently about this idea that the Fed is perhaps operating as if short-run R-star has increased, and Governor Waller has in the past sounded a little bit skeptical on this. So I think we'll be looking out to see the comments from Waller on R-star on Friday as well.
Abigail, let's talk about the data you're focused on too. Kit Jukes of SocGen calling it second division data this week in America. How much weight do you think we should put on? How much attention does something like UMich consumer confidence numbers, inflation, all of that, how much weight, confidence, or rather how much focus does that deserve?
Yeah, so I think there's a couple of data releases that I would watch that are maybe not as in focus because they're slightly more lagged. So, for example, we'll be getting the data for Q4 from the QCW, and I think we've been seeing kind of a different strength in terms of the employment growth in the QCW versus non-farm payrolls, with that running a little bit slower. And so I think that's one thing that we'll be looking out for this week. There's also the quarterly services survey. These are quarterly surveys, but the quarterly services survey will impact into the kind of services spending estimates in the Q1 GDP revisions next week. And I think in light of some of the weakness that we saw in last week's retail sales data, I do think it's worth watching to see kind of whether there's any kind of revisions coming through the pipeline on the services side of spending as well. And then, as you say, University of Michigan, we'll get the final release for the University of Michigan survey later this week. And I think one of the things that, people were watching in the preliminary release was the inflation expectations series, and we did see them tick a little bit higher. So I think one thing we'll be watching is as we see that kind of full sample of receipts kind of pulling into that data, is whether we see any revisions on the inflation expectations side. So yeah, I think those are the key things that I would be watching on the data side this week.
There's another key thing that I'm watching, and that's the price of copper and the price of gold. And I wonder how much that really speaks to some sort of resurgence in the manufacturing sector. You've been talking about the weakness we've been seeing in manufacturing. How do you pair that with runaway prices in copper and even in gold?
Yeah, so I think it's a good point around the kind of strength of the manufacturing sector. I mean, if we look at the hard economic data, the industrial production data last week were fairly weak. And again, looking at what's coming this week, we'll get the S&P global manufacturing PMI. Our expectations is that we see that tick back down into contraction at 49. We have generally seen both the kind of softer maybe survey measures and also the kind of harder industrial production data kind of coming in weaker in general in the manufacturing sector. So from an economic perspective, that's what we've seen in terms of the kind of hard data on the manufacturing sector, and we kind of continue to see weakness in that in the surveys that we'll get on the manufacturing sector this week.
Abigail, we kicked off this show with Steve Chivarone saying everything's just fine. Data, fine. Economic activity, fine. Earnings, fine. You say you're fine when you don't want to get into all of the details and there's a time of flux. It's not a very exciting kind of comment. Does that work for you, that things are just fine? And if that's the case, how long can things just be fine?
Yeah, so I mean, our expectation is that we do kind of see growth slow through this year. And I think it's when you're coming off some of the resilience and the strength that you saw, 3.1% annual growth last year was a really strong growth outturn in the US. And so I think some of that kind of moderation in the pace of growth is probably kind of what you're getting there. It's just more of a kind of a slowing in kind of the economic outlook that's coming through there. And I think you're coming off kind of very obviously very strong growth print. So I think maybe that's what you're seeing there. It's just more of a moderation back down in towards more kind of a normal paces of growth rather than some of the boomy prints that we saw through last year. And it's the same on the labor market, right? We're seeing a slowing in the labor market. And I think it's more just a kind of a slowing in some of the momentum that we saw given the strength that you're coming from.
Abigail, on the heels of a lot of consumer sentiment showing that consumers are concerned, what do you make of the state of the U.S. consumer?
Yeah, so one of the ways that we've been looking at this actually is looking to see kind of both the upper end of the income distribution and the lower end of the income distribution. And what we're seeing is, you're seeing the balance sheets of those at the upper end of the income distribution holding up fairly well despite the Fed's hiking cycle. But you are seeing instead at the lower end of the income spectrum, you're starting to see some signs of stress. Obviously, recently we got the New York Fed's consumer debt and credit panel. And in that we saw delinquencies beginning to kind of continue to rise and surpassing rates seen at the end of 2019 for both credit cards and auto loans. But when we look at the distribution of who contributes the most to spending in the US economy, it's the upper end of the income distribution. And when we look at who contributes the most to the growth in consumer spending, it's the upper end. So one of the reasons why we've kind of we're still expecting the consumer to slow this year. We're still expecting consumption growth to slow, but we've had to mark up our expectations on the back of, I guess, some of that resilience in the upper end of the income spectrum.
Getting a read on this is really, really difficult, Abigail. Do you think there's contradictions between what the companies are telling us and what we're seeing in the data?
Yeah, it is very difficult to get a clear read, and I do think it's important to focus in on some of that the distributional effects. I think that is something that you can miss if you look at the headline. And I think actually if you look, so a really good example of that is if you look at overall delinquencies, they're sitting kind of well below where they were in 2019, but that's kind of actually very much suppressed by student loan repayments and the delinquency rates on student loans, and to a degree mortgages. So it masks, I guess, some of the stress that you might actually be seeing in the consumer sector.
Abigail, appreciate your time this morning. Thank you. Abigail Watt there of UBS. Attempted to break it down at what's happening with the consumer. We said last week there's three ways. It's more than that, but here's three. Ask a bank, ask a company, look at the data. And there seems to be contradictions at the moment between the three.
Depending on the company, depending on the data point, and depending on what you hear from certain Fed officials. This is the reason why it's been complicated. And Mike Wilson, to his credit, has been saying it has been very difficult to get the macro environment as he shifts to a more bullish stance.
An upgrade from Mike Wilson making some headlines over at Morgan Stanley this morning. Coming up next, we'll catch up with Stuart Kaiser of Citi, Ali Bass of the Crisis Group, Atlanta Fed President Raphael Bostic, and we'll speak to Amanda Lynham of BlackRock. Your equity market this Monday morning, positive by 0.1%.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about Do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
It's the lower end of the income distribution that's really having a hard time.
If the labor market cracks, then these delinquency issues could make this group more sensitive to a potential downturn.
Even though we are worried about US fiscal, the markets will be willing to extend that confidence in US productivity.
Seeing a severe growth slowdown, I think, is something that is further down the horizon as potential risk.
If anything happens to the labor market, which I hope it doesn't, we are going to slow down really quickly.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City. Good morning, good morning. Your equity market on the S&P 500 positive by 0.1%. Let's get you set up for the week ahead. Looking ahead to Wednesday, NVIDIA after the clock is the main event for earnings, and then it's the Fed speak. Here's the next 24 hours. Bostic, Mester, Barr, Waller, Jefferson, 7:30 Eastern Time. Mike McKee. Elisa, sitting down with the Atlanta Fed president.
So how are they going to interpret the weakness that we've seen? Is this really the return of the disinflation that we've all been hoping for? Or are they being more tepid about it? They're basically saying the way that we're hearing from a number of different analysts, we need a couple more months. More interesting is going to be Friday. Really, Chris Waller, he's going to be talking about R-Start. And I know people are thinking, R-Start, really? I'm going to care about that. This idea of actually embracing longer-term inflation expectations, do they shift? The market's shifted, do they?
Everything's fine. Could it be better than right now? You liked that, didn't you? Steve Chevron, previous hour. Everything's fine.
If you say to somebody, how are you doing? And they say, I'm fine. Does that leave you satisfied?
Doing okay.
Do you feel good? Do you feel like you understand how they're doing in any way, shape, or form?
I'm fine. Maybe they just don't want to talk about their feelings.
Exactly. They don't want to talk about their feelings, but they have feelings underneath. They just are not identifiable.
Is that necessarily a bad thing?
Well, it's just, it leaves...
a therapy session?
It leaves you wanting for more.
There's not a lot of conviction in fine.
Thank you.
I think the Morgan Stanley note this morning puts it right there in the forefront. Since the beginning of 2023, the consensus view in the macro backdrop has bounced between hard landing, soft landing, and no landing outcomes, which leaves you kind of with, we're fine.
When things are fine, it means there's no news. And when there's no news right now, that's good news, because all the news over the last 3 months, 4 months, has been about upside inflation surprises, which is why inline is the new beat in financial markets. Fine is good right now, which I think is what Steve was trying to communicate.
So right now, fine is good, but when you have people who are paid to trade every single day, fine is not good enough. Fine is sort of this anxiety-producing, what am I missing? What's going to come and bite me? Because right now we're looking at a situation that could potentially turn. You could have a labor market weakening. You could have the wrong kind of disinflation with weakness that then undermines fine.
There's always something to worry about.
That's true.
Sometimes you should worry about upside risk to markets as well, not just downside risk, Bramo. This is what Morgan Stanley's got to say this morning, following an upgrade in both Europe and in the US as well. A sunny macro environment, a clearer path of disinflation, growth and policy over the next few months sets us up for a constructive outlook across markets.
How much of this really depends, though, on fiscal spending? How much of this has to do with industrial spending? Because at this point, I do wonder if we're really okay if you get the same kind of creep higher in the initial jobless claims. I understand things are looking pretty good. But why is it when you talk to people, they don't feel good? We still go back to that. Why is it that you're still seeing certain cracks in certain segments of the population? I don't know. I mean, fine is a mystery to me.
Well, it's because part of it is it's really hard to explain to the American consumer that, yes, the rate of inflation is coming down, but the prices are never going back to what you remember. But speaking of upgrades, Jonathan, I know you brought up Binky Chadha earlier today, 5,500, because he says the earnings cycle having plenty of legs. And we'll see that this week with NVIDIA.
He thinks things are fine as well. The one thing that got Steve nervous, it was interesting, the one thing that got Steve nervous is that a lot of people agree with him. That was the one thing that got him nervous.
Yeah, well, and he said, I said, what are you doing with fine? I mean, you just basically sit there and take times off and go hang out with your kids, which is lovely, and I think it's wonderful. But I just wonder if, he said, I am actually getting nervous and questioning my theory because it doesn't feel like this is something sticky.
After NVIDIA, 2 weeks of summer, Stuart Kaiser of Citi is going to join us in a moment. That's what he's going to talk about. The scores right now on the S&P 500, equity futures positive by 0.1%. Stu's just around the corner. Look out for that following 4 weeks of gains in the equity market. Ed Mills of Raymond James will be joining us as well. Looking forward to catching up with Ed on the latest in the Middle East, and Atlanta Fed President Raphael Bostic on the Fed's path forward. We begin with our top story, kicking off the week with all eyes on NVIDIA. Citi's Stuart Kaiser writing this: markets will be captivated by NVIDIA earnings, but after that event, there are about 2 weeks without clear catalysts. Last quarter, Russell 2000 and S&P 500 equal weight both outperformed the S&P by about 200 basis points between NVIDIA earnings and the March CPI report. We like positioning for a similar pattern. Stu joins us for more. Good morning, Stu.
Good morning. How are you?
Is fine good? Is 2 weeks of no data a good thing?
Honestly, it's going to be a really big test because last week when you had kind of no data, the market was able to, or 2 weeks ago when you had no data, the market just sort of trended higher. You had a nice clean week. I think this time you have a 2 week window. It's right around month end. The question I think is, with the market at an all-time high, do people kind of trim some risk and do you get a little chop, or is it everything's fine and dandy? Actually, if you add dandy, it makes it much more enjoyable.
It does.
If it's fine and dandy, I think you can kind of drift higher. So our view is strong earnings season, the same way you had a strong earnings season last time. That tends to favor large cap because they're generating the bulk of the earnings. Once you get out of that kind of earnings event, we do think you can get a little episode of broadening into that big June 12th day.
With the emphasis on a little episode and not maybe a durable broadening, why is that?
I think there's still, as you all have highlighted, there's still some anxiety, kind of in the system. I think a lot of it, to me, revolves around the labor market. I think that's the area that is by far the biggest risk to equity markets. And if you look at the KC Fed labor tracker or other metrics, there are some sort of cracks or little weeds kind of in the garden that you need to deal with. And I think that's going to kind of keep people a little bit conservative.
And you pointed to the idea that momentum has not recovered alongside the broader market. I was talking about that. We were talking about that earlier. I thought that was a really interesting point, that this isn't necessarily the GameStop frenzy that's going to fuel the everything up kind of moment, and yet you're still constructive. What do you take from that? The idea that momentum is not really driving this?
It might be a little bit of kind of buy the rumor, sell the fact type issue. You had very strong earnings from TMT companies. I think that's really what stabilized the market that week of kind of April 26th or so, right? And I think now that you've gotten through that period, people are probably taking a little bit of profits and maybe taking a little bit of risk off the table. I mean, we're back at all-time highs again. We were below 5,000 pre-TMT earnings. We're at 5,300 now. So I do think you're just seeing some people kind of adjusting positioning, and maybe it's sell in May and go to the lake type situation,
So is that what you're recommending? Do you feel fine?
I feel pretty good, actually.
Okay, but that's different than fine. I just want to say that. One thing that you pointed to was initial jobless claims. And I thought that was interesting because I remember when people used to care about those, and then they started to flatline, and then everybody ignored them. Is that going to be first-tier data this week?
Yeah, I mean, claims are important. If you think back to last summer, last June we printed 105 in non-farm payrolls. You got claims, kind of above 250. If we got a repeat of that, obviously the market's not going to like that combination of data. So claims matter. It's just tough when you're at such a low level. You would need a significant step up in claims, I think, to get people's attention. Kind of ticking up 10K here or there is not going to do it. You're going to need a significant step higher of claims to be disruptive.
Stuart, how do you read the inflation data? Because when we saw the bumps early in the year, it was just that. This is bumps, not a trend. Then we get one print that's basically in line, and everyone's all excited saying, okay, we're back to the disinflationary trend off of one report. Is that fair?
I mean, it's a good question. The reason people are taking it so well is I think they interpret the Fed as taking it very well, right? This is a Fed that has sort of a cutting bias to it. And I think the market is saying if you're printing 30 basis points of core CPI, that gives the Fed kind of leeway to cut later this year. If you keep printing 30 basis points of core, you're almost back to 4% by the end of the year. So, 30 basis points is probably not going to do it medium term. But right now, I think it gives people confidence that the Fed is kind of willing to cut in that environment. We said at the beginning of the year, your sort of uber bull case for markets is you soft land or you don't go into a recession, and the Fed does a couple insurance cuts behind that. Because that gives you a strong EPS outlook, and potentially you get a little bit of juice on the valuation side. So that was kind of what could get you up to those 5,500 type levels. That's what the market wants, ultimately. It's what we all want. So, when you get data that allows you to confirm that a little bit, I think the market tries to run with it.
You've said for a while that when the labor market starts to weaken, you're going to get nervous. Your team is predicting that on the economic side of the research division.
Yep.
What does that mean for your call? Does it just become increasingly short-term and much more tactical? Is it much more difficult to have a longer-term view of where this equity market's going to be?
100%. I mean, we'd recommended hedging a little bit, the last month just to kind of manage that risk. The risk reward of the market is not what it was 2 months ago in our view. You've had, U.S. economic surprise has gotten quite negative. You've got some hiccups going on in the labor market. Earnings are strong, but it's starting to get priced in. So yeah, we're keeping it much more tactical. When you get volatility down to these levels, I think it makes a whole lot of sense either to hedge or to use options for your upside. I mean, you're paying sub 10 implied volatility for upside on the S&P. That feels like a very responsible way to have your kind of long exposure on. So yeah, we're much more tactical, much more careful, and I think the market is showing you that it's going to be responsive to bad news. Unfortunately or fortunately, we just haven't had that bad news.
How high is the bar for Wednesday for NVIDIA? Got another call right now in front of me, this time from Stifel on NVIDIA. Price target raised to 1085 from 910. The quote, beat and raise widely anticipated. Same thing came from Barclays early this morning. All signs still point to another revision higher. How high is that bar Wednesday afternoon?
I think it's a pretty high bar, man. The market's gotten used to them basically beating by $2 billion, every quarter for a number of quarters in a row. $2 billion used to be a big number. So I think it's the bar is pretty high, for NVIDIA here. Perhaps a little less high than it was a couple weeks ago when, the market was sub 5,000 and there was a little bit of stress in the system. But the issue with NVIDIA is it's been a huge part of revenue and earnings growth. It's also a huge part of market cap, which is why if you take the NVIDIA implied move and, kind of multiply it by its market cap, it could move the S&P 40 to 50 basis points that day by itself. So, the bar is definitely high. The way we track sort of sentiment, it's not quite as aggressively high as it was last quarter. Last quarter, you had inverted skew, which means your calls cost more than your puts. That's highly unusual at the single stock level. Some of that has started to come out of the system. So bullish, definitely. Bar is high, but it does feel I think people are starting to just accept the fact that you can't continually beat by $2 billion every quarter, right? So I think people have kind of prepared themselves for a little bit. It'll be fine, I think.
You think it's going to be fine? You feel fine?
I think it'll all be fine, yeah.
Fine and dandy, which is actually better than that. I will just say, one thing that I find interesting is that we used to have companies that were bellwether companies, whether it was the banks, which no longer serve as that, whether it was Walmart, which maybe no longer serves as that either. It's sort of a Walmart story, not necessarily a macro story. Is NVIDIA serving more as a macro story in terms of AI adoption? Will we get a sort of broader read-through to the market and sort of the sentiment behind it from NVIDIA than just an NVIDIA story?
I think definitely so. I think NVIDIA has become a macro story. You see how aggressively it's even priced into the S&P 500. These events are like our market-based events. I think we've talked in the past, there's a view that AI, increases productivity and can potentially lift GDP growth on a go-forward basis. It has massive impacts on the labor market. So, AI at large is a macro story. NVIDIA is right now the cleanest, most direct way to trade that. So it's made that, a macro story. Eli Lilly and those with the GLP-1s, I think, would fall into that category as well. Those are probably the two sort of single stocks or themes that have become macro over the years.
Anne-Marie said it, data point of the week, right? Data point of the week?
Yeah, Goldman Sachs last week said $1,100 per share that they uplifted for NVIDIA. This is the data point, I think, whether or not the markets will be fine or maybe less than fine.
Wednesday, after the close. You got a word on Man City?
Sad.
Couple of words?
No,
sad.
Are they the Mets?
Not fine.
No, they're not the Mets. Unfortunately, they're not the Mets. I root for the Mets of the EPL, which is the unfortunate situation.
I hear you.
Stu, it's good to see you. It's fine. It's going to be all right. Stuart Kaiser of Citi. Thank you, sir. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Japan's benchmark bond yield has hit a decade high. 10-year JGB yields are up by about 2.5 bips today to 0.75%, a level last seen in 2013. Houses from Vanguard to PIMCO expect 30 or more hikes this year, eventually sending yields to 1% or more. MUFG's Derek Halpenny told me earlier this morning that the market was still underpricing the start of Japan's hiking cycle.
We're expecting 15 basis points in July. Possibly we get up to a range of 40 to 50 basis points around the turn of the year. I think certainly a more hawkish BOJ, and I think the markets are underpriced for what's coming.
That was on the Bloomberg Brief, which is every weekday morning at 5 a.m. Eastern. JP Morgan has lifted its full-year net income to $91 billion versus the $90 billion that it predicted in the first quarter earnings release last month. The firm also raised its expense guidance for the year to $92 billion, but that's largely due to a $1 billion donation the bank made to its JP Morgan Chase Foundation. The new guidance comes ahead of its annual investor day in New York. And shares of Ryanair falling this morning in the Dublin trade, down 1.25%. The airline announced ticket prices in the summer may be flat to modestly higher, but the carrier also says that strong demand is there despite constrained capacity. Bloomberg spoke to the Ryanair CFO Neil Sorahan earlier today.
We're taking in over 600,000 bookings a night, so demand is huge, and my advice would be to yourself, Tom, and everybody else, book sooner rather than later, because I think fares are only going to go in one direction.
Stick around for our interview with the Ryanair CEO, Michael O'Leary. That's in about an hour's time at 8:15 Eastern. And that's your Bloomberg Brief. John.
Big conversation coming up about pricing a little bit later through the summer. Danny, thanks for that. More from Danny in about 30 minutes' time. Up next on the program, Iran's president killed in a helicopter crash.
Geopolitical risk is elevated still further by these deaths. It's going to make Iran essentially double down on its own stance, I think, for the next couple of months.
The latest out of the region coming up next, live from New York City this morning. Good morning.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Live from New York City, welcome back to the program. Monday morning is the price action. Equity futures on the S&P 500 shaping up as follows. Positive by 0.1%. On the NASDAQ, positive by 0.2%. On a Russell, up by 0.2% as well. Lisa, that's 4 weeks of gains for the equity market.
Guess what happened to the Dow? We didn't even talk about the Dow.
We never do.
North of 40,000 for the first time, crossing that mark. I saw that and I thought to myself, wow. You know, if someone were here, we'd be talking about that for like literally the entire day. So I thought I'd mention that. But yeah, the question is, can it continue, and how much is this really hinging on the idea that the Fed can do some insurance cuts?
I can see TK at the corner of my eye in the other studio. He's already messaged me this morning. So if you want to get some Dow chat and you get in the car, maybe you're at home right now, Bloomberg Radio for a lot more on that.
Wall to wall.
Let's switch to the board from the equity market and turn to bonds and talk about what's happening in fixed income. Yields just about unchanged at 441.59. We've had 3 weeks on a 10-year of declining yields. Fed speak, economic data, it's all, Lisa, pushing in that direction over the last month or so.
What did you say, one speed for Fed Chair Jay Powell?
One gear, dovish, and it has been that way for a while.
Which is the reason why if you get some downside surprises to the economic data, it's been viewed as a good thing because it gives them a pass to finally do what they want to do, which is cut rates. Question is, and you raised this before, John, how much do you see the weakening in the data being bad news is bad news in the sense that you are seeing some sort of real slowdown that is negative for a lot of the more rosier projections?
That's the bond setup. Let's turn to foreign exchange and give you a sneak peek of what's happening with the euro, and then I'll finish on commodities for you. The euro at the moment about 108.66, but to Lisa's point, all of that stuff coming together, pulling down yields, push that into the FX market, weaker dollar and a slightly stronger euro, and we might have more upside ahead, at least in the short term, according to the likes of Kitjukes and SocGen, given the second division economic data you get this week, which is unlikely to move the dial on the US side of things, maybe giving Europe some space to outperform again. Look ahead for the PMIs at the back end of this week. I mentioned commodities. I do just want to finish on gold and copper. All-time highs on both gold and copper. And just to sit on copper, what did Jeff Curry, formerly of Goldman and now of Carlyle, say recently that this might be one of the trades of his career over the last 30 years?
He called it one of the best long trades ever. He said that to Lisa and myself, and then he also joined Tracy Alloway and Joe Weisenthal on their podcast. He is so bullish on copper. And this has to do so much of the industrial play and not just the manufacturing boost, but also the fact that this is the commodity to have for electrifying the grid and the green energy future.
Copper right now up by 2.6%, a word on gold positive by 0.9%. We've seen a series of all-time highs throughout 2024 so far in the commodity market. Under surveillance this morning, Iran's president killed in a helicopter crash.
Of course, geopolitical risk is elevated still further by these deaths, but that the impact could be quite limited. It's going to make Iran essentially double down on its own stance, I think, for the next couple of months anyway. That 50-day bogey in terms of a new election is very important, and they're going to go out of their way to show that it's basically business as usual.
Here's the latest. Iran's supreme leader announcing 5 days of mourning following the death of the country's president and foreign minister. They were killed when their helicopter crashed returning from an event on the Azerbaijan border. The Ayatollah saying an election for Iran's next president will take place in the next 50 days. Ali Vez of the Crisis Group joins us now. Ali, can you describe for us the next 50 days in that country, what it's going to look like?
So as of today, Vice President Mokhber has taken over the responsibilities of President Raisi and is going to, in collaboration with the head of the parliament and the head of the judiciary, organize the election. Now, what that means is that candidates would have to announce their running for the race in the next few days, and then there is a very complex vetting process in Iran that is likely to disqualify anyone who is even considered a loyal critic of the system. And it would only agree to the most loyal insiders to be able to run for the presidency, and then they would have to organize the election, which is a pretty tough challenge for the regime because they had an election, a parliamentary runoff just last week, in which only 8% of the population in the capital city, Tehran, actually showed up at the polls. And finally, they have to put together a new cabinet and get confirmation for the new minister. So it's quite a process ahead of them.
Ali, with Raisi's death, does this mean that Khamenei's son is likely going to be the next supreme leader?
You know, there's a lot of speculation around it, but I actually think it's very unlikely because this is a regime that has lost tremendous amount of legitimacy in the past few years. And if it becomes a hereditary system for a revolutionary system that came to power and toppled the monarchy 45 years ago, I think it will be kind of shooting themselves in the foot. And I think that's very unlikely. But what Mojtaba would like to do is to be able to continue running the show from behind the scenes. And that's why I think President Raisi was an attractive candidate to groom for the top job, because he was so subservient that the current office of the Supreme Leader would have been able to preserve its influence even after Ayatollah Khamenei passes.
Given the power lies in the Supreme Leader, what is going to change between today and, say, 50 days out?
Look, not much, because the president has very little sway when it gets to foreign policy or even actually internal policy as well. And especially in the case of President Raisi, who really disempowered the executive branch even more than all of his predecessors combined. And in that sense, I expect more continuity than change. But one thing is clear, that in the next 50 days, Iran is going to be internally focused. The question is whether that would provide its adversaries in the region with an opportunity to push back against it. And if that happens, the regime that already feels that it's on its back foot and in a position of weakness is likely to lash out. And given what we saw between Iran and Israel last month, I think there are significant risks there.
What does a lash out look like at this point?
Well, we saw what it looked like last month, right, with 350 drones and missiles being fired directly from the Iranian territory towards Israel. Now, thankfully, 99% of them were shot down, but this was because this was a highly telegraphed and made-for-TV attack. If it's a surprise attack and at a larger scale, it will be much more difficult to get away with it without significant death or destruction. And of course, this is just talking about what Iran could do. There are tensions between Israel and Hezbollah. There are unilateral actions that the Houthis in Yemen could take in targeting shipping in the Red Sea that might be completely uncoordinated with the Iranians. And so the risks in the region remain particularly high. The only thing that has been added to it is this degree of uncertainty that didn't exist at the top of the Iranian political system, but now it does.
Ali, when it comes to the likes of Rouhani, he recently wrote an open letter that got a lot of criticism from the hard-right members of the regime. He's seen sometimes as the centrist reformist. What happened to those individuals?
They've been completely sidelined, Anne-Marie, because the system primarily cares about ideological confirmation at the top rather than legitimacy from the bottom. And because the entire focus of the Islamic Republic right now is on the question of succession. And they want to take no risk. So they want only people who are completely loyal to the Supreme Leader's vision for the future of the country to be in charge. And that's why reformists, pragmatists, centrists, including former President Rouhani, have been completely marginalized. And I expect the upcoming presidential election in Iran to be very similar to U.S. primary elections, in which basically you have an intra-conservative election with only the most devoted members of the party going out to vote.
It's going to be an interesting 50 days ahead of us. Ali, appreciate your time this morning. Thank you, sir. Ali Vez there of the Crisis Group. Coming up very shortly on this programme, Bloomberg's Michael McKee sitting down with Atlanta Fed President Raphael Bostic. It's a busy week of Fed speak, and it starts right here on Bloomberg Surveillance. That conversation is 5 minutes away. Equity futures on the S&P positive here by 0.1%. Live from New York, you're watching Bloomberg Surveillance. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology. This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
2 hours away from the opening bell, equity futures look a little something like this on the S&P 500. Positive by 0.1%. On the Nasdaq, we're positive by 0.2. 4 weeks of gains across the equity market on the S&P 500, the longest weekly winning streak going back to February. In the bond market, a 2-year, 10-year, 30-year that looks a little something like this, following 3 weeks of declining yields on a 10-year. Your yield 4.4159, and in foreign exchange, after the biggest weekly gain for the euro going back to March, the euro looks like this against the US dollar, 108.63. Under surveillance this morning, our top story: Iran's president has died in a helicopter crash. Ibrahim Raisi was widely seen as a candidate to be Iran's next supreme leader. The Ayatollah saying an election for Iran's next president will take place in the next 50 days. And Anne-Marie, it's going to be quite a 50 days for that country.
Yes, absolutely. And we just heard from Ali Vez talking about the fact that now Iran is internally focused. They have to have not just a new president, a new cabinet, and then they're going to go to elections. And he says in that kind of circumstance, potentially Iran feels even more on the back foot and they can lash out. So we're on the cusp potentially of more geopolitical tension within this region that already is very high.
And it raises this question, too, of what exactly the election looks like in potentially 50 days at a time where it's not exactly the same kind of election as takes place in other places.
That's the latest from the region. Let's turn to the latest on the earnings front. NVIDIA reporting earnings on Wednesday after the closing bell. The AI poster child accounting for about 5% of the S&P 500 gains so far this year. The company has seen double-digit gains in 3 of the past 5 reports. Their stock is up this morning by 1.4%. We've had upgrade after upgrade, and this morning, I think in the last 24 hours, Lisa, Barclays, Stifel lifting their price targets for the stock.
And you raise this question, I mean, has the bar been lifted so high that anything other than a $2 billion beat is considered a miss? Just want to throw this statistic out. Jim Reed over at Deutsche Bank put this out there, that in the past 12 months, the share price has tripled. And in that one day alone, 1 year ago when they reported earnings that really were blockbuster, it was a 20% pop in one day. It just highlights, how significant this name is, not only to the index, but also as sort of a driver of the AI narrative that really kicked off a lot of the gains that we saw that were really unexpected.
A double-digit move on a market cap that large is just absolutely phenomenal. And let's be clear, we've seen that across a few names over the last month or so. Elsewhere, a slew of Fed speak on deck. We'll hear from Barr, Waller, Jefferson, and Mester later on today. But right now, Bloomberg's Michael McKee sitting down with Atlanta Fed President Raphael Bostic. Good morning, Mike.
Good morning, and good morning to all of our listeners and viewers on Bloomberg Radio and Television worldwide. We are at Amelia Island in Florida for the Financial Markets Conference of the Atlanta Fed, and the host has graciously agreed to join us this early morning. Thank you for being with us. I'm not going to ask you when you're going to cut rates, because nothing's probably changed in your view that it's not time yet, you need more confidence, and you've been the one saying maybe one later this year. That's the same, right?
Nothing has changed. Well, first of all, good morning. It's good to see you, and welcome to the conference. It's good to have you here. No, what you said is exactly right. The numbers have come in for the first part of this year, very bumpy, and it really suggests that inflation is going to come down far slower than I think many had expected. And so rather than focus on numbers of cuts and all that kind of stuff, really the issue right now is, when are we going to be certain that inflation is clearly on its path to 2%? I think it's going to take a while before we'll know that for sure.
Well, what is it that tells you that maybe you'll only get one or you might get no cuts this year? What do you see in the economy?
Well, we do a lot of talking to business leaders, and what they're all telling us is things are slowing down, but they're slowing down very slowly and coming off of pretty high record levels of profits and revenue. So in that instance, there's going to be continued momentum in the economy, and that momentum is just going to take a while to play through. The other thing everyone tells us, though, is that pricing power is weakening. They do know that the expansion and large growth is not in their outlooks and on the table. And so for me, that says, yeah, it's going to slow down, it's going to get there, but it's only going to be eventual.
Is it likely that inflation does go down or that it could go up again?
Well, as you know, anything can happen. My outlook is really that inflation will continue to fall through this year and into 2025. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there. But of course, the unexpected can always happen, and we've seen that through the last 3 or 4 years, where the pandemic was not expected, a war in Europe wasn't expected, and they do send ripples through the entire economy. If that happens, we'll just have to be ready and then respond as appropriate.
One of the themes of this conference is sort of what happens next. So what happens next? You're higher for longer now, and some think you're going to be higher forever, that we're not going back to low interest rates.
Well, I don't think we're going to go, well, let me say this. I hope we don't go back to zero interest rates, because that means something will have happened that requires us to go to maximum support for the economy, and that would not be ideal for anybody. I do think that our new steady state is likely to be higher than what people have known over the last decade, maybe back to where we were in the 1990s and 2000s, but we'll just have to see. But I do think a strong, important message people should have is going back to zero means that something bad happened in the economy, and we want to avoid that as much as possible.
Well, what do you say to people who want to move or people who want to buy a new car? Hold on, wait, or how long do these industries have that they can hold out until you decide what you're going to do next?
Well, I don't think anyone's waiting for us at this point on the business side. You see in the auto space that producers and auto dealers, they're adding incentives for people to buy their cars. We talked to lots of major sellers of cars. They're trying to move volume. They are trying to do those things, and I think for consumers, it's really shop around. It's like back to where we used to be and how the economy used to work. You got to go find where there are opportunities. They're out there, but people just need to live their lives. And what I'm finding and seeing is most of them are doing that. The housing and home ownership, that's a special case, and people are locked into those. But even there, because we have remote work, and we have people working in these hybrid situations, there are opportunities for people to continue to stay engaged in the economy.
Well, a lot of people look at the housing industry, for example, and other areas that have started to slow down, and there's an argument that maybe you're going to be behind the curve in cutting rates.
I don't think that that's really the right way to think about it. For me, our mandate is stable prices and maximum employment. On the employment side, we're still seeing many, many jobs being created. On the inflation side and the stable prices, we've still got a ways to go. And so for us, and I think given our mandates, we need to get that stable pricing side to where we need it to be, because at that point, then the economy will be positioned to stand on its own, to move forward, and to create growth and prosperity.
When you get asked when you're going to cut rates, and you give the answer that you give, and your colleagues get asked and give the answer that they give, you've said as a group that we're not doing forward guidance anymore. But is this a forward guidance that you're doing anyway, because it does seem like you're guiding the markets, or at least the markets are reacting to everything you say?
Well, I think the markets have always reacted to everything we say, so I don't think this is new. What I would say, though, is we are open to all possibilities, and from here moving forward, there are scenarios where the economy is going to expand and accelerate. There are scenarios where the economy might slow down faster than expected, and then there is my outlook scenario, which is slow and steady wins the race. In all of those cases, there are policy prescriptions, and we have to be ready for all of them. So in this sense, unlike in the pandemic or even the great financial crisis, when we knew that most of the risk was on one side, now the risks are really balanced, and so there isn't sort of a bias in one direction or another. I think that's the message to be taken. If you want to call that forward guidance, that's fine. I mean, to me, I think in many regards, that's life. Like life is, you don't know, and something good could happen, something bad can happen, and you just have to be ready for it.
Well, you've got another month, essentially, before you have your next meeting, and you have to put out your forecasts. But you want to give us a sneak preview of what you think growth and inflation are going to be like for the rest of the year?
Well, I've been told many times, don't scoop yourself. So I don't know. You know, the way our process works is, as we get closer to the meeting, I meet with my team. We really try to get a sense of where everybody is on this. You know, I have a bunch of great economists in our building who have their own views and opinions about how the economy is going to move forward. I take that on board, and we'll get to a narrative at that point. But right now, I'm just worried about this conference, making sure it goes off as well as it can. And I'm really looking forward to the conversation.
You're going to be one of just one dot by yourself on the dot plot when it comes out?
Well, we'll see about that.
When you look at the economy overall, does it surprise you still that we're seeing the strength in the labor markets that we are seeing? Are you hearing anything from CEOs about that turning?
So what I've heard from business leaders really is that today, labor markets are weaker than they were, softer than they were 12 months ago, but they're not soft. You know, this is a question that we ask all the time because we need to know how the labor side of input to production is doing. What I think is really important when we think about workers and the labor market is that before the pandemic, the labor markets were tight. Right? So I don't think we're likely to evolve to a place where labor is going to be many people out there available for work. We're going to go back to where we were. I will say, there have been lots of reports that show that immigration has been an important contributor, and we'll see how it evolves moving forward.
Well, the big question that a lot of people on Wall Street and I guess in a way Main Street are asking is monetary policy restrictive now? And is what you're restricting the problems in the for inflation, or is it maybe stuff you can't do anything about?
Well, look, I think that our stance is restrictive. Another thing we do, we have surveys, and I ask people all the time, do you think that our policy stance is preventing some things from happening that you would do otherwise? Every business leader says yes. Now, some of them say, it's changed my forecast over the next 12 months. I have some cash, so I can actually buy some things and don't need to use debt instruments for that. But everyone acknowledges to me that our policy rate is slowing things down. It is tightening. And that's what really gives me the confidence that we can get inflation back to our 2% target.
Well, as a last question, we're obviously in a season where everybody's getting asked their feelings about the economy. Do you think we see any significant changes in the economy over the next 6 months, say?
It's hard to say. My outlook is the economy is going to continue to be growing. Inflation is going to continue to come down slowly. The economy will continue to create jobs, and the United States economy will continue to be the leading economy in the world.
But will people feel that?
You'll have to ask them. So I think one of the things I've heard is we don't have just one economy today. We have people that are on the lower end of the income and wealth distribution. They have gone through their excess savings. They are feeling somewhat the same way they were before the pandemic. Then you have a lot of other folks who accrued a lot of savings through the pandemic because they couldn't go on vacations, they couldn't go to restaurants. They're still in a spend mode. And so a lot of what I'm trying to do today is figure out how that all fits together to give a picture of how the aggregate economy is going to move forward. Today, what I'm hearing is that there's still enough spend on that upper end that the economy can continue to grow, but it is slowing down.
Well, we will check in with you in a couple of months and see if anything's changed. Raphael Bostic, thank you very much for joining us from the Atlanta Fed, and from Amelia Island, we'll send it back to you.
Mike McKee, thank you, sir. Looking forward to your coverage throughout the day. Look out for Mike catching up with the Cleveland Fed president, Loretta Mester, a little bit later on this morning. We heard this from a few guests last week. We're slowing, we're not slow. On the labour market, Raphael Bostic of the Atlanta Fed saying this: things are softer than they were, but they're not soft. Much more on that in just a moment. Let's give an update on stories this morning. Elsewhere, here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Nippon Steel is stepping up efforts to gain support for its takeover of U.S. Steel. Nippon is sending its vice chair and executive VP to Pittsburgh this week, where they'll meet with local staff and elected officials. It's also sending technical teams to review U.S. steel mills. They're hoping to find ways to boost investment and labor commitments to try to win over union leaders. Nippon declined to comment on details. Testimony resumes today in the fraud and market manipulation trial of Bill Huang. Jurors have already heard witnesses say that his Archegos Capital Management lied to its Wall Street counterparties. This week, former Chief Risk Officer Scott Becker is expected to take the stand as one of the prosecution's star witnesses. He was a key contact for the banks for Archegos. The jury has been played recordings already where he reassures them the Huang's family office is fine, even as it's collapsing. Becker has pled guilty and will testify as a cooperating witness. Now, seafood chain Red Lobster has filed for Chapter 11 bankruptcy after facing higher costs and a disastrous unlimited shrimp promotion. The chain struggled and failed to attract customers, losing $76 million in the 2023 fiscal year. But during that year, the company also turned its endless shrimp promotion into a permanent fixture. That cost it $11 million as diners devoured plates. The bankruptcy filing allows the chain to operate while it works out a way to repay creditors. And that's your Bloomberg Brief, John.
Danny, thank you. Bramo's favourite story this morning.
100%.
Right?
Well, I mean, I never understood the logic behind selling lobsters and shrimp for that cheap. And then when you have unlimited shrimp, what do you think is going to happen? I mean, if you have teenagers at home who are male teenagers, you know that they look to see where they can have all you can eat, and then they go there and they see how much they can eat. Why do people not do that also for Red Lobster?
I'm looking at one article that talks about the fact that they did this in 2003, and this is what executives had to say to analysts in 2003. It wasn't the second helping of an all-you-can-eat, but the third that hurt profits. So then why are they doing it again?
As a promotion, I get it. Get people in. As a permanent fixture, it's a very different thing. I used to do the same thing with pizza.
Of course.
You know, but pizza, I imagine, is much cheaper to make than ordering in shrimp.
So there are always the stories of the all-you-can-eat places, and then at what point you get kicked out. That's a dare among teenagers. If they can get kicked out of all-you-can-eat places, among some circles. I'm not saying.
The boy's been going to Red Lobster.
I'm just not.
Okay, all right. Up next on the programme is In Line, the new beat.
From here, it could be this benign environment where you have a Fed reaction function that we think is a bit more dovish, some relief on the inflation front, and that's very constructive for credit heading into the summer.
That conversation up next, live from New York. You're watching Bloomberg Surveillance.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Live from New York, welcome to the program. Equity futures on the S&P 500. Just to check in on the scores, look like this. We're positive by 0.16%. Under surveillance this morning is in line, the new beat.
As you saw with CPI, just getting something in line was enough to really see a lot of relief in markets, a rally in credit included. I think from here, it could be this benign environment where you have a Fed reaction function that we think is a bit more dovish, some relief on the inflation front, and that's very constructive for credit heading into the summer.
That's the bullish outlook. Here's the latest this morning. Light on data and heavy on Fed speak this week. Atlanta Fed President Raphael Bostic saying just moments ago, rather than focus on numbers, the issue right now is when we are going to get certain that inflation is on its path to 2%. I think it's going to take a while before we know that for sure. Amanda Liner of BlackRock joins us around the table. Amanda, good morning to you.
Good morning. Thank you for having me.
Great to hear from the Atlanta Fed President about 10, 15 minutes ago with Michael McKee. This is what he had to say on the question of being restrictive. He said that he would ask corporations the question, is it preventing you from doing something you would do otherwise? And overwhelmingly, they'd respond yes. Do you think we are restrictive?
I think that we're restrictive in certain pockets of the market, but I think in general, corporates are still moving ahead with what they need to be doing. I think the one area of concern, I think, for corporate credit is there's a lot of focus on the timing of rate cuts, and it seems like the market's expectation is that once this rate cut cycle begins, it's going to be a deep rate cutting cycle. My question is, what if we stop at 4%? What if we stop in the high threes and we're there for a long time? Does that start to change the corporate calculus? I've been encouraged to see that actually high yield corporates are now chipping away at late 2025, early 2026 maturities. So I think they're saying we're not waiting for this near-term significant rate relief. We're going to kind of move on with it. The one area where you are seeing, I think, maybe activity be subdued to the rate environment is in LBO activity. So not strategic M&A, but kind of sponsor-related M&A, where the financing decisions are more of a, I think, integral calculus to the returns. Strategic M&A has actually rebounded quite nicely. So I think in general, yes, there are pockets that we've discussed previously. You can find them in liquid and private credits of companies, I think, underperforming, and that probably won't turn anytime soon. But my bigger focus is, again, not on the timing of the rate cutting cycle, but how far do we go in rate cuts? And that will really matter for corporate credit.
The base case is we begin in the second half, but you've said it a few times. Not all rate cuts are created equally. Can we talk about that a little bit more?
Sure. And so that is an admittedly wide 6-month range. I mean, and previously we had been guiding towards the earlier part of that. In mid-April, we changed it to say that actually the risks are quite balanced between the earlier and the later part of that 6-month range. Yes, not all rate cuts are created equal. So if we're getting rate cuts because of a deterioration in the labor market, that is an environment where I would expect credit spreads to be much wider because these are growth-sensitive asset classes. If we're getting rate cuts because of an improvement in inflation, which so far has been somewhat elusive, except for April, maybe, then that's a much more benign outcome for credit. By that same token, if we are not getting rate cuts until very late in 2024 or early 2025, because growth is just so strong, credit can digest that. But it's really that sustained reacceleration in inflation that is really the concern, because at that point, it introduces credence to the prospect of a rate hike, and that uncertainty for monetary policy is just really not good for credit, specifically that deal making.
To your point, Raphael Bostic just saying going back to zero rates means something bad happened in the economy. So in terms of not all rate cuts are created equal, the balance of risks, though, has shifted, and you really outlined this well, in the sense that the high-yield market has basically termed out a lot of its debt. You've seen the supply really shrink in terms of just the total outstanding debt. Private credit's not that story, though, and you are seeing covenants loosing. You're starting to see a little bit more leniency by lenders as the competition heats up. At what point does this become a problem?
Sure. So first on the high yield supply, you're absolutely right. And one of the stats that I found striking, 77% of the year-to-date high yield new issue volumes, which actually are elevated, were earmarked for debt repayment or refinancing. So it just goes to show you that corporates are being prudent. Actually, in private credit, we track an index. It's the Lincoln International Private Market Markets Index. It's 5,000 U.S. portfolio companies. Somewhat counterintuitively, covenant defaults have declined for 4 consecutive quarters through the first quarter of 2024. Now, part of that is the increased flexibility that those corporates have. So around 16% of those companies in that universe got an amendment from their lender. But I do think it speaks to this inherent flexibility in the long-term lender relationship that for all else being equal, a same company with the same macro backdrop, same business model, are they better placed to make it through the other side in the private markets versus the public markets? We think that the private markets afford them that flexibility.
The good news is it doesn't sound like there's some massive wave of defaults as some people had worried about when rates went up. The bad news is Fed policy really effective? Is this actually working through the economy if there's so many other ways for people to finance?
Right. I think it goes back to kind of this overarching point of how unique this cycle is. In previous cycles, if you would have looked at tightening in bank lending, rate hikes of 525 basis points, you would have expected a corporate default rate in the 9-10% range. Instead, we're hovering around 5.5% to 6%, depending on the asset class and the region. So I think it does speak to the fact that corporates entered this position from a position of strength in terms of the high interest rate environment. They've refinanced in 2020 and 2021. They have other avenues for funding in terms of the private markets. And in some areas, the economy has not been as interest sensitive as we would have expected. Again, there are pockets of vulnerability. For sure, we're seeing that across the board. You can find those in a lot of places. But yes, I do think it speaks to the unique nature of the cycle. The one thing that we're really watching is, that is true so far, kind of 2 years and change into an elevated cost of capital. What if that is a common feature throughout 2025? How do corporates behave in that? At some point, I think what matters in both private and liquid credit, if you're lending to a company, are you lending to a company that can grow in a cost-efficient way, in a capital-efficient way, or are they just kept afloat by what was previously a low-rate environment that we don't expect to
How temporary is this? And that's kind of what you're getting at. So let's go through one of those themes, sources of finance.
Yes.
How structural is this? Is this a permanent shift where they can get access to finance beyond where they just used to get it?
Yes. I mean, I do think a big part of the growth in private markets is permanent. And the key differentiator is that while the idea of middle market lending is not new, that's been around for decades, as a standalone, sizable, scalable asset class, we believe it's here to stay. And so in that instance, this asset class can compete in areas where it previously couldn't, like overlapping with the addressable market of public borrowers. And so I do think that is here to stay. Now, that will ebb and flow, that competition between public and private markets where companies choose to access funding. But on net, I think that's a positive. But again, the important thing will be, are these companies growing in a capital-efficient way? Can they actually make it through the other side, or were they the so-called zombies that were kept afloat by a low-rate environment? And no one should be lending really to those companies in public or private markets.
Amanda, I say this every time you come on. One of the best. It's good to see you. Thank you. Amanda Lynham there of BlackRock. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Phil Camporelli of JP Morgan, the Ryanair CEO, Michael O'Leary, Stephanie Roth of Wolfe Research, and Mark McCormick of TD. From New York with futures just about positive, this is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
We're getting closer to a point where we might actually see cuts this year.
We're still looking for easing now to begin in September.
The Fed put is still alive and well in people's minds. The more credible bear case would be a re-acceleration inflation.
If it's not a trend down, in fact, it is just inflation hanging out where it is, then I think they keep postponing.
Is the inflation target the right target? We all talk about wanting to go back to 2%. 2% is totally arbitrary.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, getting your trading week started with equity futures just about positive on the S&P 500. Good morning to you all. The Fed speakers already started this week. We caught up with the Atlanta Fed President, Raphael Bostic, sitting down with Michael McKee. The takeaway from that, it's what we've heard a lot already over the last week or so. We're slowing, but we're not slow. Labour markets are softer, but Lisa, they're not soft.
And guess what? We don't really know anything. And guess what? That's life, because we don't really know what's going to come around the corner. The one thing that really stuck out to me is going back to zero means something bad happened in the economy. Going to Amanda Lynham's point, not all rate cuts are created equal, and they're not sure what kind they might be doing.
It's going to be an odd couple of weeks, because on Wednesday you get NVIDIA, then after NVIDIA, there's basically nothing for like 2 weeks after NVIDIA, going into CPI. Because on June 12th, there's everything. You have CPI and the Federal Reserve and a ton of other things happening that week too.
But when it comes to NVIDIA this week, Jonathan, this is the stat that stands out to me. Analysts expect NVIDIA grew earnings by more than 400% in the prior quarter, while revenue increased 242%. That has to do with Bloomberg consensus data. And when you think about coming into this earnings, whether NVIDIA does well or not can really spell what's going to happen, whether this market is fine or not so fine towards the end of the week.
Lisa, the data point of the week, apparently.
Yeah, NVIDIA. I actually think that it might be the 20-year auction on Wednesday of treasuries. $60
That would be
billion.
very on brand.
That would be, I mean, you never know. Supply might matter in a week, in a week of economic data. Now, I actually am very curious to hear what happens with Chris Waller on Friday. I know not all Fed speak is created equal, just like not all rate cuts are created equal. Do they really address the idea of where the longer-term inflation rate really is at a time where people are saying, including Mohamed El-Erian last week with you guys, that it's structurally going to be higher higher, and you have to kind of just embrace that.
Governor Wallace set the tone for this committee before, did that last year. Be interested to see if he does the same thing later on this week as well. Let's start with the scores this hour. Equity futures on the S&P 500 just about positive by 0.15%. In the bond market, yields just about unchanged on a 10-year 4.41. In foreign exchange, the euro slightly negative against a stronger dollar, 108.61. Coming up this hour, we'll catch up with JP Morgan's Phil Camporelli on why nervousness around rates is overblown. Ryanair CEO Michael O'Leary in the building on the ongoing impact of Boeing delivery delays and what's happening with prices this summer for flights. And Stephanie Roth of Wolf Research on her outlook for slowing inflation. We begin with our top story. Stocks edging higher following 4 weeks of gains. JP Morgan's Phil Camporelli saying this: stocks trading at all-time highs after reducing the number of cuts in 24 from 6 to less than 2 is a really good sign. We do not think the economy needs an imminent cut in rates, and importantly, we are not counting on an ease to validate our overweight. Phil is with us around the table. Phil, good morning.
Good morning.
Last time we spoke, you were super upbeat about bonds and stocks. Has that changed?
Yeah, and to be clear, it was our overweight to credit on the bond markets. We'd much rather play offense in fixed income than defense with our view of the U.S. economy staying out of recession. Yes, we still are overweight stocks. And I think the biggest point for us here, if you can get the U.S. consumer right, John, you can get your asset allocation right. And our U.S. consumer today, and I hate to say this, but this time is in fact different, John. So why? This is the first time since 1984 that the federal funds rate is higher than the average effective mortgage rate. And I went back to look at this, and I love this stat. The Fed is charging 5.5%. The consumer is paying zero interest rate policy. So the average mortgage rate, effective mortgage rate that folks were paying from 2008 to 2015 when we were in a zero interest rate policy was about 4.3%. The effective mortgage rate today is 3.8%. That's really important. And the other piece is the high yield market. If you were a homeowner, you refinanced your mortgage in the pandemic. If you were a CFO, you went into the office and you refinanced your corporate balance sheet. John, only 2% of the high yield index is coming up for maturity this year. Only 2%, only 6% next year. You got to go out a couple of years to get some serious issuance on the high yield side. Now, I think the economy is enormously interest rate insensitive. We know that. That's why we're not in recession. But here's the other piece. You don't need an interest rate cut. What's an interest rate cut going to do to validate your overweight to stocks and bonds? And I think that's why the last couple of weeks were so important to us. The bigger signal is the MOVE index, or interest rate volatility, not the number of cuts that are being priced in, because we've just had 6 straight quarters of above trend growth. We'll see where the first quarter comes out.
Sure.
At a time when we had high interest rates. This signal is really important.
Let's unpack some of this. Let's talk about whether they are truly restrictive or not. When you hear Fed officials say we are restrictive, what are you thinking?
Yeah, so not as restrictive as they probably believe at this point. So there's a couple of things on one side of the balance sheet. There's a $7 trillion Fed balance sheet, and there's a 7% U.S. fiscal deficit. And we just talked about how interest rate insensitive the U.S. consumer is. I think maybe for speculation, they're probably restrictive. But in terms of getting folks to stop spending, I don't think they're as restrictive as they might think they are. But that's a high-class problem, John. It means that we're not going into a recession. I mean, you can get to 2% inflation in a hurry, in a hard landing, but I think this is going to be a really lagged, probably the most lagged effective monetary policy that we've ever seen because of just how unique this cycle was.
Yeah, as we were speaking, I was thinking to myself, everything is fine because Fed policy doesn't work. Is that basically the way that we can kind of frame this?
It won't work, Lisa, if we get accelerating inflation, and I think that's where we have to draw the line. So Jerome Powell in his last press conference really raised the bar for them coming to back in and hike. They'd have to see significant evidence that their policy is not restrictive. I don't think you can go there yet until you get, and this is important, wages picking up. And I think the wage story being at or around 4% around long-term targets, this is just a really good environment to take risk. And if wages aren't accelerating, I think they could be on hold for a while.
I guess one thing that I've been doing recently is talking to different people who I engage with about how are you feeling about the economy, truly, because I've been curious about this idea that people have been feeling pretty crappy about it, frankly, even though the economic data points to something different. And it's uniform. People do not feel good because of the level of inflation. The people who feel good, who are wealthy, they feel good, right? But everybody else is really kind of struggling. Yeah. So at what point is allowing inflation to run hot and to even entertaining the idea of rate cuts actually making it more difficult for a certain subset that really is flat on its back and is rate sensitive, very much so.
Yeah, Lisa, we are 100% in agreement with that. Like, I'm talking about an asset allocation decision and the U.S. economy avoiding recession. But there are folks, and we see it in our card data, where delinquencies are picking up in kind of the lower income cohorts and the lower ages. That stuff is happening. It just, I don't think, is enough, Lisa, to drive the economy into 2 consecutive quarters of negative GDP with negative job creation.
So how much do you lean into that story and just go straight luxury? Go straight, basically, everything that's catering to people who are wealthy, to people who want to lose weight, thank you, Ozempic, to people who are on the chip train, and just ignore the rest.
Yeah, it's not ignore the rest. I think the big global secular themes are something that we're focused on. So you mentioned AI and obesity drugs, and we don't have to stay in the U.S. I mean, 40% of NVIDIA's supply comes from Taiwan Semiconductor, as you mentioned. You can't watch a sports game without seeing, or live TV at least, without seeing an Ozempic commercial, which is obviously outside of the U.S. So, you know, those are big secular themes that we're focused on in our portfolios. But it's not just that. Again, I can't stress enough, if you don't have a recession view, things like high yield credit make a lot of sense. Not because we get this incredible spread, but because we're getting extra yield over the ag, Lisa. So we are focused on those big secular themes, but as an asset allocator, I have to think about stocks and bonds, and within bonds, we still like the high yield.
Can we just get within stocks just a little bit more, away from AI, and away from weight loss? What is it you do like? Is this a broad, equal weight S&P 500 story? What is
good question, John. So I have to manage against a global index, the Morgan Stanley All Country World Index. So in that world, we have about a 6% overweight to stocks, so in a 60-40 type portfolio, that's a 66% allocation to stocks. 2/3 of that overweight are in the U.S., S&P, okay? And then the balance of that, we have an overweight to developed non-U.S., so we do like the European story. We mentioned a couple of those themes. We do like Japan, and then we're neutral emerging markets. Quietly, emerging markets are making a little bit of a comeback. Not necessarily willing to go overweight yet because we like the U.S. and the developed non-U.S. story a little bit more, but we would not be underweight emerging markets here.
Is that a China factor in EM that holds you back a little bit?
Yeah, so it certainly is. So there's a amount of confidence that we cannot get to yet with emerging markets driven by the China story that we can get to in the U.S. and non-U.S. markets.
You're not alone.
Yeah.
Over the weekend.
Thank you.
Yeah, I mean, like, well, I mean, anytime. It's fine. It's fine and dandy, as Stuart Kaiser would say. Now, here's the issue, right? A lot of people have been talking about emerging markets as part of this reflation trade, and the commodity sector is part of that too. Yeah. And what I find interesting is where are the limits to this, where suddenly this becomes a problem, right? Where the reflation trade, I know I'm always looking for the problems, but I guess that's, you know, what people do. Yeah. But I'm just wondering at what point you start seeing some of the increase in commodity prices as a headwind, especially if you are worried about some of the strength being a little bit too strong and you are worried about the idea of inflation rearing again.
Yeah, so Lisa, there's like a line in the sand, and most people think it's $100 oil or something like that, that we would start to think that that would be kind of like a tax. Whereas, you know, we have a long way to go to get there, but also in emerging markets, they've been so beat up and so left behind that any reflation right now is good for that market. But there is a point, obviously, right, where the commodity story then becomes the tax. We're not close to that yet, and there's two things that look cheap. One of them is emerging markets, the other one is small cap. We don't want to be underweight either of those, but small cap, I think you would really need to see multiple Federal Reserve cuts with above trend growth, which is not our view. So we'd rather be overweight large cap versus small cap.
Phil, you go right to oil, but really the commodity story is metals right now. Yes. Copper, a record we've seen overnight in London. Isn't that a concern given what we are seeing in terms of the changing economies in the United States, in Asia, also in Europe?
So we have actually upgraded our view, Anne-Marie, for precious metals in our long-term capital market assumption. Why? Because, you know, the last cycle was not the new normal. We think that over the next decade, Anne-Marie, we're going to see two-way risk on inflation, the way we always saw it before 2008. But, you know, in the post-financial crisis, there was only a one-way risk, getting inflation to 2%. So I think the precious metals story makes sense in a structural asset allocation based on the view that you may not get the protection that you necessarily have been used to getting in fixed income, so you make room for precious metals.
Phil, this was great. It's good to see you, buddy. Always is. Upbeat. More than just fine. Phil Camporelli of JP Morgan on both bonds and equities. Put this one in the diary for this morning, a little bit later on, 11 a.m. San Francisco time. Ed Ludlow catching up with the CEOs of Dell, NVIDIA and ServiceNow. Jensen Huang with Ed Ludlow a little bit later.
All I can think of is Dan Ives' description of Jensen Huang. Come on, you know, the rock star. He gets his leather jacket on, he goes on the stage, and he does what he does, and he talks about how incredible their business model is. We'll hear about that later.
And markets go up 20%, just like that.
Let's
get you an update on stories elsewhere this morning. Carissa Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. One of Wall Street's most prominent bears has just capitulated. Morgan Stanley's Mike Wilson now sees the S&P rising 2% by June of next year. So he's boosted his target to 5,400 from 4,500, which would have been a 15% drop. Wilson and the Morgan Stanley team say that they expect a sunny macro environment, but Wilson did reiterate his view that outcomes are harder to predict with volatile data. He had said last month that he was steering clear of big calls given that economic uncertainty. Mike Wilson joins surveillance at 8 a.m. tomorrow Eastern. Saudi Crown Prince Mohammed bin Salman is postponing a trip to Japan due to concerns about his father, the king's health. The trip was set to begin today and would have been the Crown Prince's first visit to Japan in 5 years. Saudi state media reported that the 88-year-old king is suffering from inflammation of the lung. MBS, who handles most day-to-day affairs in the kingdom, is next in the line to the throne. And Jeff Bezos' Blue Origin resumes sending tourists to space. It launched 6 private passengers on a flight more than 60 miles from Earth. It's the company's 7th tourist mission on New Shepard to date, and its first since August 2022. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, the morning calls, plus Ryanair CEO Michael O'Leary looking ahead to summer travel demand. Here in New York, Michael O'Leary up next.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup.
This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, equity futures positive here by 0.2%. A little lift on the S&P 500. In the bond market, yields unchanged at 441.59. Time now for the morning calls. First up, Barclays raising its price target on NVIDIA to 1,100. The analyst seeing $1 billion in upside for first quarter data center revenue. A stock is up by 1.3%. Next up, Morgan Stanley upgrading Micron to equal weight. The analyst pointing to strengthening demand for AI-related products. And finally, Jefferies initiating coverage on U.S. Steel with a buy rating, $45 price target. The analyst highlighting a positive macro backdrop for the metals and mining sector thanks to ongoing U.S. economic strength. That stock is up by 1.2%. Let's turn to travel. Shares of Ryanair lower this morning, with the airline saying summer fares may be flat despite low capacity. Ryanair planning to offer discounts to stimulate demand, and the CEO, good friend of ours over the years, Michael O'Leary, joins us for more. Michael, good morning to you and welcome to New York.
Morning, John. Great pleasure to be here again.
Great to catch up with you, sir. So let's talk about pricing. Your own CFO said it was counterintuitive. Help me understand it. Capacity's down, prices are flat. What's going on?
Difficult to understand it ourselves. Like we've come off 2 summers of 20% plus price increases. So we thought pricing this year would be softer. We thought up 5 to 10. At the moment, it looks like it's flat to 5% through the summer peak. I think there's just a bit of consumer resistance out there. Capacity is constrained in Europe. We thought that would lead to stronger pricing. Easter was early. That means that April, May, June is a little bit softer. We still see pricing up through the peak, July, August, September. We're constrained because of Boeing delivery delays. But I think pricing is going to be softer than we had originally expected this summer. Good for consumers, not necessarily quite so good for shareholders, but then we've launched a 700 million share buyback today, so that'll keep shareholders quiet while we look after consumers all summer long.
Just to be clear, the trend for summer then, soft right now, but you do expect prices to increase, fares to increase as the summer progresses?
Yeah, there's no doubt in the April, May, June quarter, pricing is down on the prior year. Now, we had a full Easter in April. This year, we had only half an Easter there. Pricing still looks, but it's up small. It's very weak, 0 to 5% through July, August, September. We've only sold about 40% of the seats in that quarter, so it could still be up slightly higher. It could be lower. We're reasonably relaxed. We have costs well under control. We've hedged our fuel forward for the next year. We've saved $450 million on fuel for the next 12 months. So we can use that to stimulate pricing. And when we've done some price stimulation in recent weeks, we've seen very strong responses from consumers. So I think consumers are there. They're a little bit nervous. Spending is weak. But when you give them a price incentive, the volumes are very strong.
Does this take some of the pressure off the 23 deliveries of Boeing jets that you're waiting for that could be delayed? Because ultimately, capacity is less of an issue.
Yeah, I mean, I don't think so, Lisa. I mean, I would prefer to take the aircraft. We could fill those aircraft through the peaks. If through July, August, September, we think travel will be strong, pricing will be strong. We regret the fact that we'll be 20 aircraft short. We've crewed up, so we have all the pilots and the cabin crew. Our labour will be a little bit higher in that second quarter, but volumes lower. We've had to pare back our full year traffic forecast this year from 205 million to about 200 million passengers. So it doesn't really help, because we're geared up for the growth, and we're just going to be Boeing going to leave us 20 aircraft short.
You've always been known for being incredibly cost conscious, trying to bring a lower cost to the consumer. Are you trying to get a deal on some of these Boeing jets? Are you looking to maybe buy some from others, or say if you want to shift to Airbus, that's fine. I'll take your MAX 737 jet.
Well, we've already said when United came out with those stupid comments earlier in the year, we're not going to take those MAX 10s or MAX aircraft. We'll take them. If you don't want them, we'll take them.
Did you?
Yeah, no. They they mumbled and then decided they were going to take him anyway. Look, aircraft deliveries are incredibly tight. Airbus and Boeing are running way behind on their deliveries. There's a real capacity constraint story in Europe for the next couple of summers. Manufacturers are delayed. Airbus fleet is 20% of the Airbus fleet is grounded because of the Pratt & Whitney engine issue, and Europe is an Airbus market. So capacity is constrained. Why it's a little bit surprising, pricing is soft this summer. We thought pricing would be a little bit stronger because of those capacity constraints. But hey, if the consumers are a little bit more price conscious, if they're a little bit more price sensitive, we'll stimulate. It's good for our business because we're the lowest price provider.
Michael, what are you hearing from Boeing at the moment? Because in the past you said you thought the deliveries could slip further. How much further are we talking?
Well, Anne-Marie, good question. I think 2 things. One, we're 20 aircraft behind. We're supposed to get 59 aircraft for this summer. We're only going to get 39 at best. But we do see signs of improvement in recent weeks. I think Stephanie Pope and the new team in Seattle are doing a good job. They're taking fuselages are not being taken from Wichita unless they're completely defect-free. But we're not yet seeing a speed up in the turnaround times in Seattle. They're still taking 12, 14 weeks to produce an aircraft, whereas it should really be 8 to 10. Now, 2 weeks ago, they sent us an update. We were expecting 2 deliveries in June, 3 in July. We're getting 2 in June. It looks like 7 in July. So we're beginning to see the situation improve, but it's very small baby steps. We're still going to take aircraft through August, September, and October, even though we can't fly them during those months. We think we'll get all 59 aircraft in this calendar year. And then the big issue with us at Boeing is, will we get the 29 aircraft deliveries we are contracted to deliver us between January and April of 2025. So I think they're making small steps, little progress, but we don't want to see any further bad news.
If that's your big question going into next year, then how do you weigh the impact, and what does that mean for your business for 2025?
I think at the moment it means that for 2020, for FY20 March 25, we're going to be doing 200 million passengers instead of 205 million. For March 26 or summer 25, we think we can step that up. I think we'll get most of those aircraft from Boeing, and then we'd like to see ourselves grow to probably about 215 million passengers through summer 25 into March 26. We think there'll be a strong rebound. We still think pricing will be reasonably robust across Europe because capacity is going to be constrained. Airbus and Boeing can't deliver any additional aircraft. The engine issue is a huge problem for the Airbus fleet. You know, they've been talking about 350 days to repair these engines. We think it's going to be 500 days. So a lot of Airbus aircraft are going to be grounded for the next 2 or 3 years.
How much do you see, just going back to this idea of pricing power, and that we're surprised that there's not greater degree of pricing power given some of the constraints with deliveries? How much is it sort of the end of the boom that we saw in the travel, and that people are constrained by the fact that, you know, hotel prices have tripled? You can see that any restaurant you go to is that much more expensive. Anytime you travel, I mean, it's incredibly expensive. So how much have we sort of reached the tipping point where we're going back to something that's pre-pandemic and not this you can work anywhere and travel all the time kind of mentality?
I mean, I don't think we've reached that. I think Europe is a fundamentally different market to the US. North America, you've seen a lot of travel price inflation in the last couple of years. You know, the average fare Southwest charged last year was $170. The average fare in Ryanair across Europe was 48 euros. So there's still a bit to go in Europe, but there's no doubt in my mind that the European consumer is cutting spend, is careful, they're cautious, they want price stimulation. We go out with seat sales, we sell out straight away. But, you know, we have higher interest rates, government's cutting back on inflation. I think consumers are just a little bit nervous there at the moment. I don't think that's a longer term trend. I think, you know, interest rates will fall, if not this year, through into next year. I think we will see some rebound in consumer spending. But I think they will protect travel. The experiential spend will continue. It'll just trend down to the lowest cost provider, which in Europe is Ryanair.
Is this a time to get more aggressive and go after market share in certain geographies?
I would love to. If I could get more aircraft out of Boeing, I'd be on it like a rash. We are taking more market share, though, at the moment in Central and Eastern Europe. Wizz have grounded 45 aircraft. Nobody else is expanding in Europe. So we are winning huge amounts of market share, despite the fact that our own capacity growth is constrained by Boeing delivery delays. So we're taking market share. I think that will continue. But if I could get more aircraft, I would try and grow faster at the moment, albeit at the cost of lower airfares.
You've got a good read on the consumer. Do they care what plane they fly on?
No. I mean, most of them don't know what plane they're flying on. I don't know what plane I'm flying on most of the time.
Do you not check?
No. I mean, if you look at whether it's the Boeing NGs, the Boeing Max, I mean, I prefer to fly in a Boeing Max aircraft only because, A, it's materially quieter, and I know that plane is burning about 16% less fuel than the older fuel guzzly 737 NGs. Boeing are making great aircraft. They are getting a lot of unfair publicity in the last 12 months.
You think so?
You know, a nose wheel falls off an
What's been unfair about it?
A nose wheel falls off an Air Canada aircraft, or an engine cowl comes off a Southwest, and it's a Boeing aircraft.
Slightly concerning, no?
Yeah, but it's a maintenance issue for those airlines. It's not fundamentally a 737 issue. The 737 is a great airplane. They're making phenomenal new engines. I mean, the engine technology is being transformed. We can't wait to get the MAX 10s. We're due to get the first of them in 2017. They'll carry 20% more passengers, but burn 20% less fuel. So not only will it transform our economics, but it will make us a much better, more greener, cleaner airline to fly on.
Michael, it's good to see you.
John, good to see you.
Thank you, sir.
Thank you very much.
Thank
you. Michael O'Leary there, the Ryanair CEO. Equity futures positive by 0.1%. Live from New York. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Minutes away from the opening bell with equity futures right here on the S&P positive by 0.1%, on the Nasdaq up by 0.2%, just about unchanged on the Russell following another week of gains across the board here in the equity market. Mike Wilson and Morgan Stanley making the headlines. New price target 5,400, old price target 4,500. That's quite an upgrade from Mr. Wilson over at Morgan Stanley.
At a certain point, you have to kind of go to where the market has gone, which is that basically earnings have been better than a lot of people expected. You're seeing earnings growth after the first quarter. They're about on par to where they were in the fourth quarter. We're looking at about 7% earnings per share growth, which is kind of in line or a little bit more than people previously expected.
Do you think Dubravko and Marco over at JP Morgan are up next?
I think so. I mean, that's the lone sort of bearish call out here is JP Morgan, 4,200. And what gets us there? What weakness are we going to get that can suddenly, completely torpedo the momentum we've seen?
This market has got away from a lot of people. Bear in mind where we were only back in September, October time. Steve Chevron was with us from Federated earlier on this morning. We kicked off the morning with him, and he said he had a price target of what? Was it 5,200? Something like that. Price target was made in September. 4,400 on the S&P 500. Completely different time. You're talking about upside of 15, 20% back then. And we've got a very different story now.
The idea that 5,200 is a bearish call now because it means the market has to go down at a time when you have to wonder what's going to torpedo it. The bigger takeaway to me, and honestly, to me, the discussions that we've had this morning and for the past couple of months, Fed policy has not been very effective. As much as people want to say it's restrictive, for the overall macro economy, you're not seeing it be effective in the same kind of way that it has historically.
Let's turn to the bond market, Lisa, and look at yields. Just quickly, 2-year, 10-year, 30-year. 10-year at the moment, 443.74. Yields up by about a basis point. On a 2-year, just about unchanged at 483.29. Over the last 3 weeks or so, the trend has been clear, particularly at the long end on a 10-year. Yields have been declining for 3 straight weeks. In foreign exchange, you want to finish on the euro for you. The euro against the dollar at 108.56, negative by 0.1%. The dollar right now against the bulk of G10 is stronger, with the exception of the Swedish krona, for whatever that's worth to you, going into the opening bell at about 1 hour's time. Under surveillance this morning, Iranian President Ibrahim Raisi killed in a helicopter crash. State news agencies confirming his death, along with the country's foreign minister, after rescuers spent hours trying to locate the crash site. The chopper went down in Iran's mountainous northwest region after dense fog covered the area on Sunday. Anne-Marie saw some of the pictures coming out over the weekend. No wonder they couldn't find that chopper.
And they had a call in the likes of Turkey to go help them to find this helicopter that had Raisi, had Hossein Amir Abdollahian, the foreign minister as well, who was the main conduit, Jonathan, remember, in 2023, to really have that rapprochement with Saudi Arabia. So now what you have is an Iran that's going to be looking internal. You have the vice president coming up, and he'll be a caretaker, and they will announce elections in the next 50 days.
The next 50 days, a lot to watch in that country. I want to turn to this story. Nippon Steel is not giving up. It's looking to sweeten its proposed U.S. steel takeover. Japan's top steelmaker is sending its vice chair to Pittsburgh this week to meet with local staff and politicians. It's also sending technical teams to review U.S. steel mills in an effort to boost investment and labor commitments to try to win over union leaders. It's not just union leaders they need to win over, Bramo, and that's the problem.
Part of this feels to me like, how much time do you bide and how much of the road work do you sort of lay before the election? The election happens and then you can get it done. Basically, that before the election, there's no way, because President Biden has made it pretty clear, and he doesn't really want to let a foreign company buy a U.S. steel company because it falls under national security and all sorts of different arguments that we've heard. But afterwards, a lot of people are saying it probably will go through.
Well, also depends in the White House, right? Trump has also vowed to not let this deal go through. Biden's words recently when he went to Pittsburgh was, this is an iconic American company for more than a century, and it should remain totally American.
Trying to get the unions on side to try and change that story. Good luck to them. Another busy week of Fed speak on deck. Bostic, Barr, Waller, Jefferson, Mester kicking things off later on today. Investors also looking ahead to the minutes from the last Fed meeting, jobless claims, and UMich consumer sentiment. Joining us now to discuss around a table, Stephanie Roth of Wolf Research, together with Mark McCormick of TD Security. Stephanie, first to you. We heard from the Atlanta Fed president about an hour ago. He said things were softer in the labor market. They weren't soft. Would you agree?
Absolutely. We've seen a softening. The latest payrolls print was arguably a Goldilocks type of print where you had a 175 payrolls number, which is good by historical measures, and an average hourly earnings print that was on the softer side. We're starting to see some signs of softening. I have to say there are some concerns in the market out there that all of a sudden the labor market's going to start to crack, and there are no signs of that. I think people are just taking the narrative and running and taking the opposite of what we saw in Q1 and flipping it upside down. So that's not a fair characterization either. Realistically, we're just seeing a rebalancing in the labor market that's actually working out fairly well, in part driven by immigration.
Mark, to bring you into the conversation, should we flip Q1 upside down? Is that what Q2, Q3, Q4 has in store for us?
No, I would agree. I think a big part of it is the market's kind of taking what's a positioning and a technical narrative, and they're overlaying it into fundamentals, and you're seeing maybe some reversal. But if you look at some of the more important prints as well, like employment cost index, if you look at some of the other indicators that we track on inflation, there's no sign here that inflation's cracking. And to me, if you look into details, it's still pretty robust and is relatively strong. So I think also if you put it in line with where the Fed's supposed to be, Fed is basically looking for 15 basis points month over month to basically get their 2.6% year over year. And it looks like even PCE, core PCE is tracking about 25 basis points right now. So it still feels like there's a very big disconnect.
Stephanie, do you agree with that there's this idea that reflation or sort of a resurgence of an inflationary wave is the biggest risk right now and looks more and more feasible given the backdrop?
It's definitely the biggest risk. Is it one that I'm particularly concerned about? No, because the inflation data are starting to look a lot better. Q1 was certainly driven by seasonals, and in my opinion, Powell seems to believe that as well, although in the latest press conference, he probably couldn't lean on that. But what we're starting to see is a real normalization in inflation, and the latest print told us that. And I think this was the most important clean read of inflation that we've gotten this year, because seasonals were really driving up Q1 inflation, and April was a lot better. So now we're tracking core PCE of the 25 basis points. If we just get OER coming back down a little bit and financial services, then you'll be back down towards 0.2% month on month, and that's exactly what the Fed is looking for. So it's very easy come the summer months to actually be tracking along those lines, and then the Fed should be able to be comfortable cutting in, say, September.
Even though you do still see this resurgence underneath the hood of just some sort of stickier inflation, commodity prices getting a little hotter. Mark, from your perspective, you're talking about how that's your fear. At what point is this driving flows internationally into the U.S. at a time when some people are saying, well, a weaker dollar can actually make sense, and other people say, well, just hold on a second, because on a relative basis, rates are so much higher in the U.S., strength is there, and the Fed won't be able to cut as much as, say, the ECB.
Yeah, it's very interesting because there's a clear focus on growth and inflation. And towards the end of last year, when we were bearish the dollar, there was a convergence with the rest of the world coming into the U.S. And U.S. exceptionalism basically peaked last year. Everyone now seems to be overlaying this like fading U.S. exceptionalism now, which I think is quite interesting because this is more about positioning and this is more about valuations that were extremely stretched in favor of the dollar. And then get a couple good data prints. But what we're seeing, if you start backtesting and trading FX strategies, the FX market basically just changed its focus entirely in March on inflation. So I think the one thing that's very interesting about the Fed is it's very asymmetric from a risk perspective right now. There is an election, it's the big elephant in the room, and there is no room for error for one inflation print to come in through the summer above expectations and still be able to reliably expect September to actually be live. And if you take out September, then you have November and December. So how is the Fed going to cut in November around the election? And given the results of the election, how could the Fed potentially cut in December? And so the way that we're thinking about it from like a trading perspective is that you could have inflation kind of go back to the levels that people are comfortable with. But do you price in 3 hikes? Do you get more confident that you just get 2? But you get one bad number, and that basically makes September a very tricky indicator, especially to trade it into the election. So I think a big part of this is we know that other G10 central banks are about to cut, but we're not very clear on whether the Fed can and whether they will. And I think the big driver here for the currency markets and for markets in general is inflation divergence. And that's what our models and our signals are telling us that we should be focused on.
And Mark, there's tons to unpack there. It's the politics that stands out for me. What convinces you the politics and the election is so important? When we go back to 2012, September, they announced QE3. Why does it matter so much more this time?
I think a big part of it is rates of inflation. So we can see that you get policy actions and it's usually not a problem, but inflation is way above target. And so it's like this would be the first cut with very elevated inflation in a very tricky election where the polls are neck and neck and there's just a lot on the line. It's a very contentious election just to even start. And I think the policy implications from one side or the other are so massive that the market is placing so much emphasis, especially for the FX market, because it is the most actionable way to look at the presidential implications in terms of tariffs, in terms of tax cuts. Those are two big things that are sitting on the table for next year. The corporate tax cuts will expire, and the discussions around tariffs will remake the entire currency market. And this also fits into the story around the geopolitics, around capital flows, where, again, if you look at what's happening with the renminbi, if you look at what's happening with currency markets, like China and Russia and emerging markets are aligned where they are basically settling currency in renminbi. They're finding ways to kind of nudge themselves away from the dollar. And this is why gold is trading at the levels that it's at. So there are so many implications for this. And so I think with this in mind, the easiest thing to think about is how much can the Fed cut into the election if inflation is still well above target?
Stephanie, does the election matter?
I mean, I think the Fed's in a tough spot, and they've been in a tough spot all year. And Powell has indicated they're planning on cutting if the conditions are right. So it's purely on the last part of that statement, if the conditions are right, which means that core PC needs to be trending at about 0.2% month on month. And as Mark mentioned, it has to go exactly right in order for the Fed to cut. If they have a couple of missed prints in the next couple of months, then yeah, of course the Fed can't be cutting. But our base case is that you have a lot of conditions that should be continuously disinflationary between now and September, and then they'll be able to move. But at this point, they're kind of caught in a box, and they have to just go on what they've indicated as key benchmark indicators. And if those things are consistent with the Fed cutting, then they're going to be cutting. No, regardless of what they do, they're going to be painted as politicized. So it's a really tough one. So our base case is they can still cut in September. November's probably out, and then December is the next one.
But Stephanie, that's if inflation is on the trajectory lower. But if there's a move and a bigger softness in the labor market, that would give them this impetus and maybe some cover to cut into an election, do you think?
Absolutely. If you started to see softness in the labor market, they would have every indication to cut. And this is different from where we were a year ago. At the beginning of 2023, they were in a position where inflation was so high that if we saw weakness in the labor market, they couldn't cut immediately. But now we're talking about 2.5% to 3% inflation. That's a much different backdrop than when inflation was trending significantly higher. So they're now able to be a lot more nimble and even be able to cut interest rates even if inflation is still a little bit sticky and lean on the employment side of their mandate.
Mark, you see that there's very little room for the Fed to be cutting rates, or you could see them not end up cutting at all this year just simply because it's inconvenient timing. At the same time, you see a resurgent inflation as one of the biggest risks. So put that together in terms of what's going to be the main driver of either dollar strength or weakness.
So yeah, I'd say the last couple of months we flipped. We're quite bullish the dollar, especially against G10 currencies. I think that is the backdrop that it's asymmetric, right? It's like from a risk trading perspective, like our view is that the Fed can cut. That's our economist baseline call. But I think when you think about the markets and how people have to deal with the risks around it, to me the risk is if there's no room for error and data is extremely volatile and we constantly have to look at revisions, these kind of things to understand the trend. The trend in U.S. inflation is quite different from all the other countries that you track in the currency market. So I think the other implication is that the asymmetric kind of outcome is one where if you think about, again, the market was very excited that Powell said that there's no hikes. That's fine, but we weren't starting this year, the market was talking about 5 or 6 cuts, and now we're saying it's okay that we don't get any hikes at all, or we don't have to have that narrative discussion around it. But I think if you think about it this way, if we do have a more volatile fall and inflation's generally sticky and the polls are kind of leaning towards kind of a change in leadership, for the dollar, it has to price in the risk of tariffs. It has to price in the risk that corporate tax cuts will be extended. So in a very strong economy that's dealing with elevated inflation, you now have macro policy that's moving more inflationary. So the market will have to reprice the expectations, whether or not it evolves in that way, but it will have to basically reprice a narrative next year that is, the rest of the world is cutting. The U.S. economy looks like it could get stronger, and the fact that you're adding tariffs makes it much more inflationary. So you kind of have to rethink the way that you look at the entire markets, particularly from the FX side. So for us, we are looking for a strong dollar against G10 currencies, but we also like the commodity story. So it's still a buffer for some emerging markets that are generally seen as exporters, but it is, again, kind of moving back into that terms of trade shock. It's also a world where it kind of creates conditions where we were expecting financial conditions to ease this year to see the economy evolve in a better state. And if what we see is U.S. inflation and the Fed and the dollar creating a little bit of a tension around that, then we can't realize those financial conditions, and we can't realize the growth expectations that were priced in this year for next year. So that's what starts to see the volatility increase. That's what starts to see carry trades unwind. This is kind of what adjusts market sentiment. And I think these are the risks that we have to be really focused on. And that's why we're more bullish the dollar in the back half of the year.
Stephanie, just to tease out one part that he was talking about, this idea that tariffs would mean that the dollar would essentially be stronger, that some of the protectionist policies that some people are talking about being implemented, especially if there is a change in leadership, would cause more inflationary pressures and would cause a stronger dollar because the Fed would have to remain higher for longer. Is that kind of an outcome that you agree with?
I mean, it's certainly a difficult one, and that might be how the market prices the election initially, but base case, first of all, the tariffs wouldn't go into place into 2026 because that's when the TCJA expires. Second of all, it's possible that the labor market is actually in better balance by the time the election comes. So the Trump administration turning off some of the immigration flows might not actually be as inflationary as many fear. And by the way, the Biden administration has done a lot of spending themselves. So it's not actually entirely clear that if we do get a change in administration, you'll start to get a real pickup in spending. Either way, we're going to be getting tax cuts extended. The Trump or Biden administration in the next cycle would be extending the tax cuts. It just depends if you carve out the upper income people, which is what the Biden administration would do. It's not going to be a boost to the economy, certainly when you're thinking about tax cuts, because it's actually just extending what we have today. And the tariff one is a difficult one, and I would view that as more, certainly it could be dollar positive, but it would also be an environment where growth would likely weaken as well. The policies that Trump has alluded to with a 60% China tariff or 10% across the board tariff would be incredibly difficult for growth. So realistically, it's possible it wouldn't actually be that inflationary. The Fed should probably just pause, see what happens, and then they would likely react. So it's not as clear cut as Trump is inflationary and the Fed would no longer be able to cut in that environment. That's not necessarily the case.
Mark, when it comes to tariffs and it comes to these tax cuts, both of these issues coming into play 2025, whether or not it's Biden or Trump, we're likely going to see more of the same. It just depends how aggressive they are going to be. So in that case, what do you have in terms of the direction of the dollar under a Trump 2025 or a Biden 2025?
I think the part of it is that with Trump, it just creates more uncertainty, more volatility. And again, like the way the markets are trading, the currency market right now is they're actually trading, and I hear it a lot from client discussions, and it's really the fact that the rest of the world is improving right now is why people want to sell the dollar. And we're a bit confused about it because a lot of our leading indicators are kind of suggesting that the global economy is not accelerating, it's kind of losing steam. But there was obviously some anecdotes as China's trying to clean up the housing market. The things are improving in the right direction there. Commodities are doing quite well across the board, so maybe that's again part of the reflation. PMIs and manufacturing, those things are bouncing back. So people are excited about the global economy and the slowdown in the U.S. And that is so you have to unpack it too as well, because laying out like slower growth and those type of things that would come from maybe a Trump administration is bullish dollar because it's risk off. And then, the world that the people are trading right now is kind of risk on. U.S. is slowing, but not by enough, and you can get Fed cuts, and this is dollar bearish. So I think what people are trying to figure out is which matters more, U.S. growth outperforming others, U.S. inflation being stronger, therefore the Fed has to react to that, or whether or not in a Trump administration, does the rest of the world underperform Like, do we get the rug kind of pulled out from us right now as the rest of the world seems like it's doing okay? Europe's leading indicators are improving. Does that all go away under a Trump, kind of a Trump presidency, which is what we saw the first time around, which is the U.S. kind of outperformed the rest of the world. U.S. growth looked good because basically tariffs and the macro policies that were administered basically slowed down the rest of the world. So I think that is kind of what people are trying to figure out is a high inflation kind of weak growth environment good for the dollar because we kind of move out of this Goldilocks environment. Everyone's moved back to Goldilocks, and I feel like any state we go through over the next 6 months is not Goldilocks. It's either it's something that's more volatile and the volatility, and again, there's first order and second order effects. The first order effect is you basically pricing the risk premium. Second order effect is we actually agree of like if Trump wins, it's actually you could see the dollar weaken dramatically after the first year. You could see the implementation of a new Plaza Accord, but those are a result of the fact that the dollar strengthens so much to price in the risk around these economic policies.
Stephanie, you've been nodding. Final word.
Yeah, I mean, I think it's a complicated backdrop. For now, it's going to be all about Fed policy and whether inflation can be consistent with the Fed being able to cut. The market's not going to be able to fully price in the election, certainly at least through much of the summer, and probably not until the beginning of next year when we start to really understand what those policies mean. So for now, it's going to be all about whether the Fed can be a little bit more dovish, which arguably in the first quarter, we think we just passed peak hawkishness. It was all about the U.S. exceptionalism and inflation overheating. But if you just remember back to December, we were talking about the opposite. It was immaculate disinflation. We've just been swung around by the data. And it's really all about just looking through a lot of that noise. And what we're looking at is inflation running 2.5% to 3%, a little bit too sticky, but nothing that's that dramatic, and an economy that's starting to slow down a little bit. So for us, it does actually look fairly Goldilocks, at least for the next couple of months.
Stephanie, this was great. It's good to see you. Stephanie Roth there of Wolf Research alongside Mark McCormick of TD Securities. Looking ahead to the data this week and the Fed speak as well. Bostic, Mester, Barr, Waller and Jefferson in the next 24 hours. This on Waller from Citi. Andrew Honhorst. Governor Waller's comments tomorrow may have more impact than stale minutes released on Wednesday. I think a lot of people would nod as they listen to that. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. JP Morgan has lifted its full-year net interest income to $91 billion versus the $90 billion it had predicted in its first quarter earnings release last month. The firm also raised its expense guidance for the year to $92 billion, but that's largely from a $1 billion donation that the bank made to its JP Morgan Chase Foundation. That new guidance comes ahead of its annual investor day in New York City. And testimony resumes today in the fraud and market manipulation trial of Bill Hwang. Jurors have already heard witnesses say that Archegos Capital lied to its Wall Street counterparties. Now, this week, the former chief risk officer, Scott Becker, is expected to take the stand. He'll be one of the prosecution's star witnesses. He was a key Archegos contact for the banks, and the jury has already been played recorded conversations where he reassures them that Hwang's family office is fine, even as it's collapsing. Becker has pled guilty and will testify as a cooperating witness. And the NBA conference final matchups are set. Sadly, the Indiana Pacers beat the Knicks at MSG in a dominating Game 7 performance on Sunday. Now they take the top seed Boston Celtics. That series starts tomorrow night. And in the Western Conference, the Minnesota Timberwolves upset the defending champion Denver Nuggets. The Wolves came back from a 20-point deficit in the second half to take the series. They'll be facing the Dallas Mavericks in a series that starts on Wednesday. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, setting you up for the day and a week ahead. That's just around the corner. You're opening about 38 minutes away. Equity futures, just about positive.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
"36 minutes away from the opening bell, with equities just about positive on the S&P 500. On our radar, 45 minutes away from that open. How restrictive is Fed policy?
I think that our stance is restrictive. Another thing we do, we have surveys, and I ask people all the time, do you think that our policy stance is preventing some things from happening that you would do otherwise? Every business leader says yes. That's what really gives me the confidence that we can get inflation back to our 2%.
Here's the trading diary for the day ahead. We'll hear from Fed's Chris Waller, Philip Jefferson, and Loretta Mester, plus Bloomberg's Ed Ludlow speaking to the CEOs of Dell, NVIDIA, and ServiceNow. Plus, it's JP Morgan's Investor Day. For a final word around the table, Anne-Marie, first to you.
Well, I have an interview coming up in the next hour with Senator Ted Cruz and Senator Katie Britt, who's actually on Trump's VP shortlist. This is going to be about abortion and IVF and how the Republicans are really trying to actually change how the electorate thinks about the Republican Party when it comes to those issues.
Ramo?
My takeaway is, what's the bigger risk, inflation resurgence or a weakening labor market? If everything's just fine, which is the sort of bigger tipping point? And what I thought was interesting today is people are kind of putting aside a weakening labor market, despite some of the population and some of what people are saying in terms of sentiment, and it really is the inflation resurgence.
It's been the theme of the morning, hasn't it? I'm not sure how nervous that makes you, that everything is just fine, apparently. Coming up tomorrow, here's your lineup: Max Kentner of HSBC, Claudia Saab of Saab Consulting, Morgan Stanley's Mike Wilson, following this morning's big upgrade, and we'll catch up with Deutsche Bank's Matt Lazzetti. Looking forward to covering the week ahead with you. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Matt Miller, looking at new records across the board. The countdown to the Open starts right now. Coming up, stocks holding near a record as a major bear capitulates. FedSpeak ramping up with limited data on the docket, and NVIDIA results in focus as earnings season wraps up. We begin, though, with the big issue, stress testing the equity rally.
It's going to be a really big test because last week when you had kind of no data, the market was able to, or 2 weeks ago when you had no data, the market just sort of trended higher. You had a nice clean week. I think this time you have a 2-week window. It's right around month end. You know, the question I think is, with the market at an all-time high, do people kind of trim some risk and do you get a little chop, or is it everything's fine and dandy? If it's fine and dandy, I think you can kind of drift higher.
Joining us now to discuss is Ethan Devitt of Moneta and Kathy Jones of Charles Schwab. And, you know, that was Stuart Kaiser, but Michael Wilson also coming out and capitulating. When he did that last year, that marks the top of the market. Kathy, what do you think of, you know, S&P 5,300, Dow 40,000?
Well, it's pretty impressive in light of the rate hikes that we've had. But it has been, and our equity strategists do talk about how it's been led by kind of a narrow group. There's some broadening, but kind of a narrow group. So I guess as the previous guest indicated, maybe this is a good test for whether it can carry on.
The narrowness has been a concern for a couple of years now, Ethan. Do you really see the broadening? Is that actually going to happen?
I already see evidence of the broadening, and we can see that with how the other sectors have actually picked up quite a bit year to date. We certainly still have the focus on the Magnificent Seven or the Fabulous Five or whatever number we're reducing them to, but certainly the other sectors, as well as other cap sizes, mid-cap and small cap, are importantly seeing some action. And it's not just about the US anymore either. Finally, markets like the UK have followed suit and are now on a par with other developed markets. So we are seeing the broadening, but it's still quite concentrated in relative terms.
How confident do you feel? I mean, I'll ask you both, but Kathy, why don't you kick it off? In a recovery based on inflation coming down, on disinflation. Are we really seeing that now to the point where the Fed is going to be able to cut rates this year?
I do see that happening this year. We still have about 2 rate cuts penciled in for the end of the year. The recent data have indicated the disinflation trend appears to be, resuming after kind of stalling out a little bit. And the main drivers here, rents and a handful of other things, appear ready to show through the data. We know in real life that the rate of increase in rents is coming down, in fact, actually deflating in some cases. We're seeing home prices fall in certain parts of the country, and that should work its way through and allow the Fed to ease rates. And we're also seeing a slowdown in other types of activity. Those retail sales numbers are telling us consumer spending appears to be slowing down after a pretty robust start to the year. So second quarter is looking slower and inflation is looking lower. So we think that will open the door to some rate cuts later in the year.
Ethan, do you agree? I know Kathy has one rate cut penciled in for September, which seems perilously close to the election for Jay Powell and co.
There's certainly going to be a lot of political maneuvering around that time, and we'll see how the waters look, essentially. But I would agree completely with that yes, 2 rate cuts on the horizon now. There's been such a much volatility, though, around that. It's been quite extraordinary to watch the volatility around rate expectations. I think at this point, the Fed knows that it's already restrictive. Staying higher for longer with inflation coming down is de facto restrictive. The transmission effect is still happening through the economy for both consumers and companies alike. Refinancings are coming, and we just don't know how the extent of that pain. So I think expectations have been set now, such if they were not to fulfill them, and we've already seen that other central banks are taking their cue from inflation falling around the world. We saw that with Sweden, and probably the ECB is next. So I think they're going to take their cue from that to have at least 1 rate cut and probably 2.
Let's talk about more closely about the Fed speak that we're bracing for this week. Bloomberg's Michael McKee caught up with Atlanta Fed President Raphael Bostic earlier.
I do think that our new steady state is likely to be higher than what people have known over the last decade, maybe back to where we were in the 1990s and 2000s, but we'll just have to see.
All right, higher than the last decade is a pretty low bar, right? I wonder what you think of the consumer holding up in this environment, Kathy. I mean, we had bad retail sales when we got the CPI number out last week, or at least disappointing relative to what we were looking for. We've seen higher income consumers step down to Walmart, which is great for Walmart, but maybe doesn't say a lot of positive things about the U.S. economy. I mean, how does the U.S. consumer, so important for growth, look to you right now, Kathy?
Well, things look okay, but as you indicated, consumers at the lower end of the spectrum are feeling pain. We're seeing delinquencies on auto loans, we're seeing delinquencies on credit cards rise pretty sharply, and that's an indication that people who, at the lower end of the income spectrum are having some problems. Upper income folks are still doing okay and still spending, but the fact that they're stepping down means that they're probably getting a little bit concerned about where they are in their spending and need to address that. I think the big factor to watch is the labor market. When people have jobs, they tend to feel pretty good about spending money and taking out loans and buying things. If the labor market shows deterioration or even just a slowdown, that could probably mean slower consumer spending. So that's what I'm keeping the sharpest eye on right now, because it's really all about that income growth.
All right, let's get down to Michael McKee. I kind of missed that cue that he's with us. He's actually on Amelia Island, not here next to me on set as he normally is. And that's where you caught up with Bostic. What do you hear from Fed officials about the U.S. consumer? I mean, Kathy has also pointed out that the labor picture is softening a bit as well.
Well, Bostic said the labor picture is softening, but not as fast as they anticipated. The same story as we're seeing with inflation. And he talked about sort of 2 Americas. One, a lower income America that has spent through the extra money they got during the pandemic and is now living paycheck to paycheck or using their credit cards to continue spending, and they're cutting back. And then there's a whole group of people who either are on the wealthy end and get a lot of their money from asset price appreciation, they keep spending, or others who had still saved a lot and are spending. So it's kind of hard, he said, to get a reading on where consumer spending is going anytime in the near future. I asked him about the interest rate sensitive sectors of the economy, and he's had an interesting comment, Matt, I know you'll appreciate this, on auto sales, that we're back to where we used to be, he said. Instead of everybody going in and getting a zero price loan and picking out the car car they want. You need to go around to dealers and negotiate again and try to get the best deal that you possibly can. So that was kind of an interesting take on how the consumer and interest rates are affecting at least one important sector of the economy.
That's the fun part of auto buying. Mike, what do you think about the effect of a rate cut on the political environment? I question usually when a call is out for a rate cut in September, but I mean, does it really matter if Powell cuts rates in September? Is that going to really have an effect, do they think, on the polls in November?
Well, it won't have an effect on the economy if they cut rates in September. It'll take longer to get into the economy. It might have an effect on psychology, and I'm sure that's what the Biden administration is hoping for. But at this point, we're still pricing out September, and November is seen as the first move. And I asked Raphael about this and whether Americans would feel anything different in the economy between now and then. And he said he didn't think so, that things are changing so slowly that, yes, inflation will be lower. Maybe we'll see a little bit less job creation and consumer spending pull back a little bit, but it won't be any kind of major shift in the economy. So it isn't going to be the economy that the administration is going to be able to count on in the election.
Michael McKee, thanks very much from Amelia Island for us this morning. Let's get back to Kathy Jones and Ethan Devitt. Ethan, let me ask you about the political picture. Do you think it has any read-through in markets? I mean, you know, Republicans, some Republicans have suggested that optimism for Trump winning in November is one of the things that's blowing up the indexes right now.
It's so hard to say. I mean, I think what we've experienced before is that the effect of both domestic politics and international geopolitics is actually very muted in markets these days. Maybe that's a sign of markets' resilience. Maybe it's a sign that really, in effect, essentially both parties are somewhat tied in terms of what they could do. The tax cuts are already in effect. There's unlikely to be a rollback of that. We're seeing a convergence around some of the trade policies, perhaps more stark rhetoric from one side, but essentially very similar policies around protectionism and tariffs. So there's unlikely to be much of a change there. And on the fiscal side, we all know from the rising deficit that there is somewhat of a hamstrung situation there too. So how different can the picture be? I think one of the only sectors that really is looking at a very bifurcated future after the election would be renewable energy and anything tied to the green transition. That clearly could have a different picture. But as far as other politics and other sectors, AI, other areas like that, I don't see a big change in that. So there will be noise around the election. If there's uncertainty, there's definitely going to be more volatility, but I don't see a big effect on the economic outlook.
Well, I'm glad you point out even the protectionist bent of, you know, both parties. It used to be, well, when I was a kid, Republicans were into free markets and Democrats were typically more protectionist, or at least that's what I thought at the time. It seems like now it doesn't matter which side of the aisle you are for higher tariffs. Kathy, is that having any effect on the market? I mean, does blocking out the competition help, for example, the U.S. stocks that make these things?
Yeah, it seems unlikely. Protectionism really never wins as a strategy over the long run. I think in the short run, it provides some safety and protection for some industries, but more importantly, we've had a lot of investment in certain industries, and so that they can compete domestically. But when it comes to, say, blocking Chinese imports, well, they can go via Mexico or some other conduit, and it may be good for Mexico. I don't know that it changes anything for us. So protectionism is never usually a good thing for the economy, and we'll see how it develops. As you say, both sides seems to be playing that game right now, but we'll just have to see how things play out. Everything is really in flux, I think, between now and the election, and particularly the deficit. That's the number one concern we hear from clients, is they're worried about the deficit. And will we extend the tax cuts? Will we have to roll some of them back? Will there be changes in the way spending is done on some of the entitlements? All that's really important, but we're not going to know that until after the election.
I wonder about the broadening out, not only of the successful stocks in the S&P 500, but the successful economies globally. Kathy, Ethan was mentioning that other economies are doing well now, as well as the U.S. How do you see that when you're looking at different markets to invest in?
Yeah, so we've seen, it looks like we're getting a little bit of a turnaround, say in Europe and maybe the UK. Things are finally picking up after a pretty sluggish period of time. We're also getting, as Aoife mentioned, the rate cuts, which I think will be important to help ease some of the constraints on those economies. Interestingly, we're seeing a lot of growth still in the emerging markets, you know, considering the strength of the dollar, the high interest rate. Some of those countries have been able to cut rates and stimulate economic growth. So the global economy is looking, you know, somewhat more optimistic right now after, I would say, a fairly sluggish pace. In the bond market, we've actually seen some opportunities in the local currency emerging market bonds. We think that that's, for somebody who's willing to take some risk and ride the ups and downs, that might be a place to pick up some extra added yield and some added potential capital gains.
Ethan, what do you think? I mean, you pointed it out. Where do you see opportunity outside of the U.S., the most opportunity?
Yeah, we've been solidly focused on global investing for some time. We believe that kind of diversification is essential in a portfolio. It's been a very difficult position to hold as the dollar has been strong and as other markets have lagged. Now, do we see that turning necessarily very soon? Not necessarily. But however, we're seeing the dollar slightly weaker, so that's probably going to bode well for at least international investing. We have been interested in Japan, perhaps not with the same euphoria as some other investors. We saw that it was overpriced. It was undervalued for some time, and now we can see that that's starting to rally. Very cautious on emerging markets, I'd say, because of some of that uncertainty around protectionism, tariffs, and China's emergence, even from their post-COVID slump. It's still happening in a kind of somewhat sporadic way. Europe, we like, but all of this will be very much a minority in terms of an overall equity allocation. We're still US dominant and just having that diversification around the edges.
All right. Thanks so much for joining us. Great talking to both of you. Ethan Devitt there from Moneta, Kathy Jones joining us from Schwab. Now, a look at some of the stocks moving ahead of the opening bell this morning. For that, we go to Abigail Doolittle. Abby?
Well, Matt, given the fact that we have the U.S. futures basically flat up ever so slightly, it is interesting to note that there are some outsized movers beneath the surface, including Norwegian Cruise Lines. They've essentially pre-announced the upside just moments ago, up about 4% in the pre-market. They've raised their fiscal year adjusted earnings to $142 from about $1.32 per share. So investors liking this news a lot. They're seeing strong demand and bookings. Johnson Controls, the building materials and technology materials company, up nearly 3%. This is Elliott, and this was, of course, a Bloomberg exclusive. Elliott said to have to build a $1 billion plus stake in the company, which has lagged its peers, according to many people familiar with the matter. This is the case, and now this puts Elliott in the top 10 investors. And then finally, NVIDIA. What would a day be without NVIDIA? Up 1.3%. Of course, it will be one of the big events this week, Matt. They report Wednesday evening after the bell. Barclays is boosting their price target ahead of time, taking a positive stake on the company, basically saying that the data center revenue will be ahead of what the street is expecting.
All right, very interesting what to watch on Wednesday from Abigail Doolittle. Thanks very much for that. Coming up, the world reacts to the death of Iran's president.
Geopolitical risk is elevated still further by these. It's going to make Iran essentially double down on its own stance, I think, for the next couple of months.
We'll take a look at the global impact next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Geopolitical risk is elevated still further by these deaths, but that the impact could be quite limited. It's going to make Iran essentially double down on its own stance, I think, for the next couple of months anyway. That 50-day bogey in terms of a new election is very important, and they're going to go out of their way to show that it's basically business as usual.
Iranian President Ebrahim Raisi, along with his foreign minister, the two have been killed in a helicopter crash. State media announced those deaths earlier today after the wreckage was found in a mountainous northwest region of the country. Raisi was considered by many to be the front runner to be the next supreme leader of Iran. For more, we're joined by Bloomberg senior editor Bobby Ghosh. Bobby, first off, what do we know about the circumstances surrounding this helicopter crash? You immediately, the mind immediately jumps to conspiracies. On the other hand, I've also read that the equipment, including the helicopter itself, were old and maybe in disrepair.
It was a very old helicopter, 1975, built, I believe, American make. A lot of Iran's flying planes as well as helicopters are very old. Remember, this is a country that has been under economic sanctions for a very long time and has not been allowed to buy newer equipment. It was a 3-helicopter convoy, we understand, traveling through dense fog in a mountainous territory. So accidents, given those two circumstances, accidents will happen. We've heard nothing yet to suggest anything other than that. The Iranian regime is extraordinarily paranoid and very quickly jumps to theories and conspiracy theories whenever the opportunity arises. We have not seen much of that as yet. We can ignore for the moment what's going on social media until we see something more concrete to suggest that there was a human hand involved. I think this is an accident, and we have to see it that way.
What is the potential for change here? I mean, this president was extremely conservative. He had been linked to numerous mass executions. He was widely seen as the potential successor to the current Ayatollah. I mean, does this leave room for a change towards a more liberal ruler, or does it reinforce the sort of conservative bent that we've seen Iran going to?
Well, you always hope when there's a change of leadership in Iran that it will be a more liberal person. But the fact is there isn't much there. There's not a great deal of genuine liberal representation in the higher echelons of the regime. As you say, Raisi was one of the favorites to be successor to Supreme Leader Khamenei. He was practically handpicked. It's a very similar CV. He even affected a very similar look, and glasses and everything. So that would be a big blow for Ayatollah Khamenei. He now has to find another protege who he can bring up to the presidency. He has 50 days to do that. I suppose you could say there is a tiny sliver of hope that the folks who are, I really hesitate to use the word liberal, but less hardline. Let's go with that. Folks who are less hardline than Raisi were might be able to put up a candidate for the election. But we saw in the last election that the regime does not tolerate anybody getting in its way. Any candidate that they don't like is disqualified and basically prevented from running a free and fair campaign. The last election campaign was the lowest, had the lowest turnout, and that sort of really hurt the credibility and of the regime. They'll be really worried about that. They have an election in 50 days, and let's say only 35% of Iranians show up. That is a real crisis of credibility that the regime does not want to deal with right now.
So what does it mean then? What does this death or these deaths mean for the tinderbox that is the Middle East relationships, Iran's relationship with Saudi Arabia, the Israel-Hamas war, and their relationship with each other as well?
So this regime has never come to this fork in the road before. They've never had a sitting president die in office. It's never happened. So what they will want to do above all else now is project stability, project continuity. Everybody in the regime rallies behind the flag, rallies behind the supreme leader, and the message they will send to the world, or want to anyway, is that nothing has changed. Foreign policy doesn't change, domestic policy doesn't change. Right. It's worth remembering that, of course, it is Ayatollah Khamenei who pulls all the strings in Iran. So the person who is the president is frankly not that important. It's important that Ayatollah Khamenei picks the person he wants, and then whoever that is, and this time it'll be somebody very likely out of the blue, whoever that is will faithfully follow through on the policies of Ayatollah Khamenei. And those policies are not going to fail.
All right, Bobby, thanks so much for joining us. Bloomberg's Bobby Ghosh there. Coming up, the morning calls. And then later we'll talk to David Dindy of Atomic Capital around the opening bell. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Time now for our morning calls. Look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley upgrades Micron to an equal weight, pointing to strengthening demand for AI-related products. Next up, Barclays raising its NVIDIA price target to $1,100 ahead of earnings. Abby pointed out those are on Wednesday night. That's all for now. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we see futures, little change, but the index is at all-time highs on the Dow, on the NASDAQ 100, on the S&P 500. So we'll see if we hold at these levels, and we'll see if we can continue to push higher in the face of Fed rate cuts that are expected to be, well, not as numerous. Let's check out some of the other action here at the opening bell. You can see the euro a little changed at 108.64, the 10-year yield at 4.44, so a little lower than that 2-year yield, I believe, right now. A little bit of an inversion. NYMEX crude off 0.7% at $79.50 a barrel. One stock to watch at the open is Norwegian Cruise. The company boosted its adjusted EPS forecast, citing strong demand. Let's go over to Abigail Doolittle for more on the Norwegian Cruise Lines.
And this means that investors are sending this stock to its best day right now, at least in about a month or so, Matt, because this is effectively a bullish pre-announce, a positive thing, clearly. They now see adjusted earnings of about $1.42 per share versus what they had seen before, $1.32. They're talking about strong demand and bookings. Now, I think a piece of this is that while their last quarter was good, it was a little bit less spectacular than some of the other cruise line companies. And while the stock is down about 75% from its pre-pandemic highs over the last year into that quarter, it had been up nearly 60%. So maybe priced to perfection to some degree. There's also a 7.3% short interest on this stock. So I think that some of today's now 5.8% move higher, that could be a little bit of a short squeeze. But again, these booking trends, the demand trends, very positive, allowing Norwegian Cruise Line to up its guidance. And in sympathy, we have Royal Caribbean higher, also Carnival. Viking now getting a bid as well. And that stock, of course, IPO just a few weeks ago, up more than 20% since that IPO. So this cruise line industry really still doing quite well. Matt, you could not get me to go on one, though. I don't think. Maybe Viking, though. Maybe
I have not. Yeah, I was going to say the same thing. I haven't ever been on a cruise. I looked around because I thought, single price tag for one holiday, but yeah, no, I don't think it's for me. Abigail Doolittle, thanks very much for that. Turning to the big stock story of the week, of the year, of the decade. Shares of NVIDIA moving higher with a pair of analysts raising their price targets ahead of Wednesday's results. Bloomberg's Simone Foxman joins us here on set with more. So Simone, NVIDIA is going to show us what's there in terms of demand for these AI chips that have been driving the stock for the last couple of years.
Yeah, and the question mark here for analysts has really been, will
people stop buying these NVIDIA chips, companies stop buying these NVIDIA chips at the same pace as they await the rollout of these new Blackwell AI chips that they're supposed to see in the second half of the year. There had been some concern that we wouldn't see that demand continue apace, but the likes of Barclays, Susquehanna, and frankly, half a dozen analysts over the last 10 days or so have come out, raised their price targets, mainly because they say this demand remains to be strong. So we checked in with Thomas O'Malley. Barclays said these concerns seemingly overblown. He says he sees over $1 billion in upside in data center revenue in the first quarter. So that's in the months since their fourth quarter ended in January that they're going to report on Wednesday. And he sees that segment revenue at about $23 billion in comparison to the $21 billion that the street consensus had. Even at $21 billion, you're looking at about a 400% increase in revenue on a year-on-year basis. So this is what's driving the expectations across the street that we're going to get a beat and a raise in these all-important earnings on Wednesday. Remember, NVIDIA accounting for about 5% of the market value of the S&P 500. So that is why this story is not just important to this name, but the broader market, Matt.
All right, Simone, thanks very much. Simone Foxman there talking to us about NVIDIA, those earnings out after the bell on Wednesday. Joining us now is David Dindy. He's the co-founder and CEO of Atomic Invest, really leapt into the news, or at least into my readings of the news after the collapse of SVB. And David, that's because you provide a platform for companies to do their daily cash flow operations through a broker-dealer rather than a bank like SVB, right?
That's correct.
So how has business been since that collapse? I mean, at the time we thought, okay, this is a great solution to the problem of, what we saw at a few regional banks at the time. Have you been building a bigger and bigger book?
We have. We've been growing in two dimensions. The first is that we've onboarded a series of new companies that are providing cash management solutions to businesses across the world. One partnership to highlight, for instance, is with Bluevine, the company that provides small businesses in the U.S., about 500,000 of them, access to platforms that offer digital banking solutions. And at the same time, we've grown just because of the demand for fixed income. We've seen trading volumes rise to over $13 billion on an annualized basis.
Talk to me about this product, because whenever I read about Atomic, you're mentioned kind of in the same breath as Robinhood, but the fact that you're the anti-Robinhood, what is that supposed to mean?
Well, our thesis at Atomic is that the future of investing is embedded and ubiquitous. Think about how you access the stock market today. You've probably opened an account with Schwab or with Robinhood, and they're providing these services to you directly through their own brand. But what we do is we partner with everyday platforms that you use, such as your banking app, perhaps your social media app, or the digital wallets on your phone, who, in our opinion, are perfectly positioned to be able to offer you access to the stock market because you use them on a regular basis. And so we help them build their own versions of Schwab and offer their own versions of Robinhood within their products.
So these are two business lines, David, that are growing for you. What are the constraints? Are interest rates painful right now? I mean, are financial conditions feeling tight to you?
As a matter of fact, it's the opposite as what you'd assume. The interest rates being high today are actually quite favorable for our business because there's been a rush of popularity of fixed income, treasury bills, corporate bonds, and the like. The challenge in the ecosystem is that trading fixed income assets is still quite difficult for the most part, and providing retail investors access to them is quite difficult. And so what we decided to do is to essentially make it much easier by providing technology that allows us to fractionalize fixed income exposure and offer that to retail investors so that they can trade fixed income the same way that they would trade stocks today.
You know, I'm pretty focused on, because we're going to talk to a couple of other guests about, direct lending versus syndicated loans, Basel III endgame rules in terms of the amount of cushion banks need to hold. How does a Basel III result affect your business, if at all?
It doesn't, because we're regulated as a broker-dealer. And so we don't loan out customers assets, at least unless they ask us to. And we don't treat those assets as though they're on our balance sheet in that respect. And so we're regulated differently. Customers don't have to worry about liquidity constraints on our side. considering the fact that they own their assets directly.
What I meant, though, is that, last year, talking about this, Jamie Dimon said that non-bank rivals are going to be dancing in the streets. Now, I think he was talking about private credit, but if new, tougher regulations make it harder for the big banks to do business, are you a beneficiary of that?
We are. I'd say on the one hand, we still operate in a manner that is consistent both with brokerage regulations and banking regulations. But at the same time, we have technology that allows us to service a broader range of consumers and customers and to have policies from an AML perspective and from a compliance perspective that allow us to do this at scale. And so as big banks are retreating, as regional banks are retreating from the space, we are stepping in with a model that we feel is more advanced and proper for what fintech companies and the ecosystem broadly needs at this point in time.
What about your access to capital as you continue to expand, David? What are your options right now, or do you need financing?
We don't need financing at the moment. As a matter of fact, we did close an additional round just late last year, led by companies like Brewer Lane, with other investors like Intuit and Samsung that see us as a strategic opportunity for them. And so at this point in time, we're well positioned to continue doing what we are doing today.
I'm always, when I talk to private company founders, asking the IPO question, because that's what gets the big headlines on the Bloomberg. But is that in your future, do you think? Would you be a publicly traded company?
Well, I think it's feasible. And ultimately, our mission is to bring wealth and make wealth accessible to every single human being. And I see it as something which will require us to eventually build towards becoming a public company. But I'd say at this point in time, we're just focused on where we are today and focused on building the best product and making these services available to a broad set of investors.
Got it. Great talking to you, David. Thanks so much for joining us on The Open this morning. David Dindy, their co-founder and CEO of Atomic Invest. Coming up, Bloomberg's Anne-Marie Horton joins us with Republican Senators Ted Cruz of Texas and Katie Britt of Alabama. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
I'm Anne Marie Hordern, and joining me now are Republican Senators Ted Cruz of Texas and Katie Britt of Alabama. Thank you both for joining Bloomberg Television here in New York.
Thanks for having us.
You're out with a joint op-ed this morning in the Wall Street Journal. The title of it will protect both life and IVF. You're announcing a bill today through this legislation that would require as a condition, your words, of receiving federal Medicaid funding that states don't prohibit IVF. Now, concerns about IVF stemmed, really, Senator Britt, from your state of Alabama.
Absolutely.
The Supreme Court came out, they said that these embryos in IVF, they are considered children under the Wrongful Death of a Minor Act. And then the Alabama legislator moved to pass a bill that would protect IVF. So why is a national bill needed if the legislator just acted on behalf of basically telling the Supreme Court in Alabama that's wrong and this is not where the American people are?
Unfortunately, we've seen a number of people try to fearmonger on this very issue. And so Ted and I came together, and we believe this effort should be bipartisan to make sure that every parent across the country who wants to bring life into this world and maybe struggling with infertility or others, but wants to use IVF to create the miracle of life, bring it into the world, has a certainty that that's going to be available to them. And so we're excited about it and believe that it's something we can move forward quickly.
Senator Cruz, then why wouldn't Republicans sign up for Senator Duckworth's bill earlier this year, which then actually would have protected what happened in Alabama?
Well, because that bill's a very different bill. That bill really seeks to backdoor in broader abortion legislation, which is where the Democrats are, but that's not IVF. Our bill is very simple and it's very focused, and it is designed to protect IVF. IVF is miraculous medical technology. It enables millions of parents to have children, to be moms, to be dads. 2% of live births in America right now today come from IVF. It's incredible. And both Katie and I agree that IVF is incredibly pro-family, that we should be standing and helping parents who want to raise kids. And what happened when the Alabama Supreme Court decision came out, there was a lot of confusion, there was a lot of fear, there was a lot of misunderstanding, and people did not want anything to threaten IVF. I agree with that. Katie agrees with that. And so we came together and said, let's draft a simple, straightforward federal bill that creates a federal right, that you as a parent have a right to have access to IVF. If you want to have a child and you need medical assistance to do so, that should be your right. This is a bill, I think, that should be overwhelmingly bipartisan. The Senate should pass this bill 100-0. We'll see if they do or not, but on the merits, that's what should happen.
Senator Duckworth's bill, though, talked about and clearly asserts that this is about, quote, assisted reproductive technology and ensures ability to cover those procedures. So in that case, do you guys think you can get a bipartisan legislation? Why not just work with Senator Duckworth?
Well, it depends. The way the Duckworth bill is written, it's very broad. There's a reason that no Republicans supported it, because it was ostensibly about IVF, but whatever it was written to give the federal government authority over abortion, potentially to strike down laws governing abortion in states all across the country. And that, I get that's the Democrats' agenda. And unfortunately...
But why not have bipartisanship on both? Because overwhelmingly,
yes,
Americans
we
want
want
IVF, but overwhelmingly, and you come from states that have very restrictive abortion policies, even majority of Republicans think abortion should be able to happen, rape, incest, and life of the mother. That's not true of both your states.
Well, listen, abortion is an issue that there are sharp disagreements. People of good faith and good morals disagree. And it's why the Supreme Court has said this is a question for the states, and every state decides it differently. And if you look at our Constitution, that's the way we decide really difficult issues of public policy, is we leave it to the voters, and that reflects and respects democracy. IVF is very different. Nearly 90% of Americans believe IVF should be protected. And so what we're trying to say is, look, let's find an area of common ground. We're not going to find complete agreement among all 100 senators on abortion. We're just not. People have different views. That's the beauty of a democracy, that we can have different views. But on IVF, we ought to be able to unify everybody. We ought to be able to get Republicans and Democrats together and say this technology, enabling people to be parents, is wonderful technology, and it is pro-family. So there are issues on which we disagree, but this is one where we can find common ground, I very much hope.
And I hope so too. I mean, we actually wrote this in that way so that it would be very measured and simple and to the point, protecting IVF, protecting families' ability to bring life into this world. And we both have talked to a number of friends and family members and others, constituents, that tell us their story about being able to bring a child into this world through IVF. And so making sure that we protect that in a way that protects religious freedom and liberty and families and others, I think, is critically important. And that's what we've done here, and we hope to gain some momentum on it.
I guess some of the concerns from some hard right members of your party would be, is an IVF embryo considered life at conception?
Well, look, I can tell you that there is unanimity. I believe all 100 senators support IVF. I don't know a single senator that does not. I don't know a single Republican that does not. I don't know a single Democrat that does not. We ought to be able to find real agreement on a question like IVF. You know, you talk about it, as Katie mentioned, she and I both have dear friends who had their children through IVF, and they're wonderful parents. They love their daughters, their sons. That's an amazing thing. You know, you look at, since the development of IVF, there have been over 8 million babies born through IVF. That is a fantastic thing, and so many families have been brought joy that we ought to be able to find agreement, and I think we will. I hope we will.
But in the discussion of IVF, abortion comes up, and majority of Americans are on the side of at least abortion should be allowed, especially in certain cases of rape, incest, life of the mother. So with that in mind, going into this election season, how do you think about abortion? Because that, for Democrats, is going to be one of the main rallying cries to get voters out, as well as tapping funding.
I think it also should be for Republicans. I mean, Anne-Marie, when you say that, I think the majority of Americans also believe you should not be able to take the life of a child the moment before the child is born.
Should there be a federal ban then?
Yet we saw Democrats vote just the last Congress to be able to do that. I mean, when you talk to people, when you talk about a child in a woman's womb at 39 weeks and actually aborting that baby, the majority of Americans agree that shouldn't be able to happen on American soil. So the problem is the Democrats are trying to deflect by how extreme they are in this position, and I think we're going to keep coming back to it, and I think we're where Americans are.
But if you say the Democrats are extreme in that position, and you want to have this IVF bill, and you think Duckworth potentially was too far on the margins coming into abortion, then would you be open to a bipartisanship bill when it comes to things like rape, incest, life of the mother?
So what I would say is today's Democrat position in the Senate is incredibly extreme, what Katie just told you. Every single Democrat in the Senate supports unlimited abortion, partial birth abortion,
I
literally.
don't think that's true.
But it is true.
Abortion.
So Anne-Marie, it actually is true because they all voted for it. We had a bill last Congress that would strike down every limitation in the country and that would legalize abortion literally until the moment of birth. That is such an extreme position. 9% of Americans agree with it.
If you look at CDC data, though, there are not abortions in America.
Okay, but every Democrat supports
there
them.
Actually are.
There are late-term abortions, and every single Democrat voted.
In extreme circumstances, though.
But every single Democrat supported it, and 91% of Americans disagree with that. The vast majority of people who consider themselves pro-choice say, listen, late-term abortion in the 39th or 40th week, that is barbaric, and that's the position of every single Democrat, which is why they don't want to talk about their position. What they want to do instead is scaremonger on IVF. They want to suggest those mean Republicans want to take away IVF. Well, let's have an area of complete agreement. Let's make clear IVF is fully protected by federal law, and
I think Democrats agree with you on there. And I would push back on them who say all of them want abortion till
but that is how they voted. I mean, at the end of the day, what you vote for matters.
And they did vote that way, and that's the thing. I just had the Secretary of HHS in front of us at an appropriations hearing, and I asked him about this administration not putting the Hyde Amendment in their budget request, something that's been bipartisan for years, and moving that forward. And then I had actually talked to a woman who performed one of these abortions at 39 weeks right before walking into there. She told me about how barbaric that is, about delivering the baby breech, about putting a knife up that baby's spine, opening it up, pulling out the brains, collapsing the skull, pushing that baby out. So it actually does happen, and unfortunately every Democrat voted to continue to allow that to happen. And the thing is we have a duty to continue to talk about that. We're one of 8 countries on the entire planet that allows for that.
So are you both calling for a national ban?
Well, there is an existing law that bans federal partial birth abortion. It's the Democrats that are calling for changing the federal law to legalize partial birth abortion. They voted for striking down every restriction. But understand here, listen, we're not going to this morning resolve all the disagreements on abortion. People have very strong, good faith views from places of deep emotion and personal experience. That's part of the beauty of democracy, that's part of the genius of the framers, is they recognize when there's questions we have disagreements about, let the voters decide, and you would expect the state of New York to have a different resolution than the state of Texas or the state of Alabama, and we've got 50 states. But what we can do is say, are there issues where we have agreement? And IVF is one of them. This bill is designed to protect something that is incredibly important, to give comfort to parents and to those who desperately want to be parents, who are scared and they're picking up the newspapers or watching on TV politicians saying someone's going to take away IVF. Well, this bill will make clear, it will be enshrined in federal law, you have a right to access to this technology.
It's also very political going to election. And actually, one of your staffers said that to the Washington Examiner. And as we head into the election, Senator Britt, I have to ask you, since you're with us, your name continuously be floated as this potential VP pick for former President Donald Trump. What is the current dialogue between you and the Trump campaign?
Look, I am working diligently on behalf of the people of Alabama in the United States Senate. We have a lot of work to do there, and I'm eager to continue that work, and I'm proud to be a part of it. There's no doubt that the American people want Donald Trump back in the White House. I mean, we are seeing that at every single poll, because people want a secure border, they want safe streets, they want stable prices, and then that's what he's going to bring to the White House. So I'm going to continue to work diligently alongside Ted to bring common sense solutions to the problems facing our country, and certainly honored to be able to do that.
But if he calls, you accept?
Listen, I am sure he has a long list, many of which are our colleagues, and we're rooting for them for sure. Bottom line is we're going to all do everything that we can to get Donald Trump back in the White House and also take back the Senate, because the fate of our nation is at stake, and we believe that that's worth fighting for.
Republican Senator Ted Cruz, Senator Katie Britt of Alabama, thank you so much, both of you, for joining us. This is Bloomberg.
All right, Anne-Marie, thanks very much for that. Now, roughly 56 minutes into the hour, 26 minutes into the trading session. Let's take a look at where markets are after they hit record highs on the Friday trade. You've got the Russell 2000 in here because we saw a little bit of a broadening out, but the Dow is one I would look at here. We were above 40,000 on Friday. We've dropped back below right now and are just hovering around that level. The NASDAQ 100 hit a new record, as did the S&P 500, 53.21 the level there. Stay tuned for my interview with Richard Farley of Kramer, Levin, Naftalis at 10:10.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. This is Bloomberg Intelligence, Alex Steele, Paul Sweeney. We drive this conversation forward. We're going to focus on the over 400 research professionals at Bloomberg Intelligence. They cover 2,000 companies, 130 industries. We lean heavily on them. And today we're going to do that as well. Allison Williams, she is at the JP Morgan Investor Day. She's going to call in and give us some of the highlights there from our good friends at JP Morgan. Plus Michael McKee, Bloomberg International Economics and Policy Correspondent. He actually had an interview earlier today from Amelia Island, Florida. Good for him, with Atlanta Fed President Bostic. So we'll get some color on that. But let's kick everything off here this Monday morning with Mr. John Tucker.
All right, Paul and Alex, we are brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. IBKR.com/RIA. Well, after last week's records, major stock averages mixed right now. The Dow has dropped back below 40,000. We have 8 of the 11 major industry groups in the S&P 500. They're down right now. Biggest drag, that comes from real estate, information technology, the best performing group right now. And that's home to NVIDIA. Of course, they report on Wednesday. Ahead of that, NVIDIA shares right now 2.6% higher. Atlanta Fed President Raphael Bostic telling Bloomberg earlier that interest rates aren't likely to stay higher for longer to try and tame inflation.
Anything can happen. My outlook is really that inflation will continue to fall through this year and into 2025. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
And just some of the individual names on the move. Norwegian Cruise boosting its adjusted earnings per share forecast. JP Morgan, of course, Allison there, you just mentioned, boosting its net interest income forecast for the year. Michael Sonnenschein stepping down as the CEO of Grayscale Investments. That's the cryptocurrency asset manager. S&P 500 right now up 15 points. Record there, up 0.3%, 53.18. The NASDAQ 100, same there, up 110 points. That's up 0.6%. The Dow down 38 points, 39,966. And let me do yields for you real quick. The 2-year is unchanged, 483. The 10-year, the benchmark, 1 basis point higher. That's at 443. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right. Hey, guys. Nice to see
Good
you.
morning.
I'm Alex Steele with Paul Sweeney and John Tucker. Paul looks sun-kissed here. I'm assuming there were weekend beach
There was a little beach time
activities.
yesterday. It was surprising.
It was a very
A
nice
little
day,
frostbite when that wind turns.
It's not, yeah, exactly. When the sun goes behind the clouds. Anyway, happy Monday, everybody. We made it to the beginning of the week. The equity markets, as I said on Friday, they just want to go up.
Yep.
People just want to buy the stocks.
I quoted you earlier. So I told Tom, I think Alex has got it. Markets just want to go up here.
And he ignored you on that.
Yep.
Yeah, pretty much. All right, well, let's get some of the details here on the stocks we're looking at. Carmen Reinecke joins us now. All right, what are you looking at today?
Yeah, so the first one that I'm looking at here, this is really an Ozempic effect move. Hims & Hers Health, it's up 26% right now. This is the biggest intraday jump since February. They're adding a GLP-1 injection offering to the sort of slate of things that they offer for weight loss. This is giving customers access to the drug that's the same active ingredient as Ozempic and Wegovy. So huge market here, obviously, for these GLP-1s. Everybody wants them. Shares of Eli Lilly and Novo Nordisk, the other big GLP-1 producers, are just slightly up today. So maybe not a huge reaction there, but for Hims & Hers Health, big move.
Okay, here's my understanding, though, is that they're able to do this. They're not allowed to make generics, but they're able to do this through compound medicine. So basically, they're able to alter a little bit of this and a little bit of that to make it different when there is a shortage of the actual approved FDA drugs. But these are not approved by the FDA. I mean, how do we feel about this? I mean, but people are pretty desperate. If you're desperate, you're going to do it. I don't know. That makes me nervous.
People are desperate. I mean, I don't know if the supply is getting a little bit better, I understand, but it's still, that's going to be an issue, particularly, they keep coming out with it solves this, it solves this, it cures this, it cures that. The whole population is going to be your market.
Well, and I'm curious about the side effects here, too, because these drugs have been around in different iterations, but the new ones don't make you as nauseous. Like, they don't have the same side effects. So these ones that are just slightly changed, that are like...
Should I do a grammar correction there?
Yes.
Nauseated.
Oh.
Nauseous is like saying, I feel poisonous.
Okay.
I feel nauseated.
Nauseated. Carmen, it happens to all of us at one point or another.
Yeah,
I'm sorry.
You're now part of the club now. You're now part of the club.
You can just say, cool, and then you give them on. It's
Then
totally
Today I learned.
Yes.
Yeah. We
I
all
tell you, that
learned from
nausea
John
is no joke, that side effect.
Yeah,
It's
exactly.
No joke. Yeah.
I don't know. I just feel, but you know what? If you need it, I guess you can get it, but just not being approved when it's still so new. Anyway, what else are you looking at?
Yeah, so NVIDIA obviously is one that everybody's looking at. It reports after the market close on Wednesday. Shares are up just under 3% right now. I mean, that doesn't seem like a huge move, but that's $56 billion.
And it's a big weight in the NASDAQ, and that's what's big, the number one driver of the NASDAQ move higher.
It also had a price target upgrade from analysts at Barclays this morning, moving its target to over $1,000 from $850, saying they see more upside for data center revenue, which is going to be a big thing when we're looking at their earnings on Wednesday. I think the average analyst target shows more than 10%, 11% upside for shares for NVIDIA from where they're currently trading, and they're near all-time highs right now. So people are really expecting some, potentially big moves here. Obviously, that earnings is going to be one that we're all watching.
Oh, yeah.
Yeah.
All right, what else you got?
Yep. So the last one I'm looking at today is Norwegian Cruise Line Holdings and CLH. So they're up today because they raised their outlook for the year. They're saying they have strong demand and they're seeing record bookings. They also unveiled a new strategy and they had sort of gave their financial targets out through 2026. So those shares right now are up about 6%. And also alongside that, we have shares of Carnival, CCL up 4%, and Royal Caribbean up about
4%, and that's actually on track. That's at an all-time high.
It's so interesting. Then Ryanair was like, ooh, I don't know about travel demand. I'm lowering the prices. Well, they already are a low-cost carrier, but I'm going to lower the prices. So there's something that's not totally syncing up here.
Well, people love cruises. I think, I think
Charlie Pellet.
But maybe Paul Sweeney come the fall. All right, Carmen, thanks a lot. Carmen Reinecke joining us from Bloomberg News. Now let's go down to the beautiful Amelia Island. It's such a hard assignment that he has. I mean, he's really got to dig deep for this one. Michael McKee, international economics and policy correspondent, joins us from Amelia Island, Florida, on the sidelines of the Atlanta Fed's Financial Markets Conference. I talked to him earlier. Apparently, it hasn't rained yet, so it's nice, and there may be an event tonight. Mike, how you doing?
I'm doing well, but you told me that at the beginning of the show that Paul was looking a little tan. I think we should put ourselves up in competition before the bosses, and they'll see that I'm still pale white here. I'm working hard.
He's working hard. There we go.
No tie, though. Let's just put that out there.
Yeah. So what's the thinking down there? What's You spoke to Atlanta Fed President Bostic earlier today. What were some of your takeaways?
Well, and Michael Barr, the vice chair for supervision, also spoke just a few moments ago, and he talked a little bit about monetary policy. And they're both saying the same thing, that they don't see inflation coming down as fast as they wanted it to. And that's obviously a frustration, but it does suggest that we're going to see later rate cuts. They're not anticipating any rate increases, but rate cuts are going to take a while to come. Now, that's not a new position from anybody on the Fed. They've kind of been there with that. But I did ask Raphael Bostic about the idea of how high interest rates will remain. And he said we might only go down to around the fours, where we were in the 1990s. People should get used to basically higher interest rates, not where we are right now. But overall, don't expect the era of low rates to come back.
I thought it was really interesting, your question on if our financial conditions tight enough, basically. Is policy restrictive enough? And he said he talks to businesses that they say that they would be doing different things if rates were lower. That's an interesting way. I didn't know that they looked at restrictiveness like that. Can you just talk me through a little bit more about that in his answer?
Well, what he's talking about is the cost of money, basically. Are people having to pay more to borrow? And businesses would borrow more if interest rates were lower, was his suggestion. But he also said at this point, the overall economy is slowing, in large part because they've been restrictive and companies aren't borrowing. And you get this feedback effect where if the economy is slowing, you don't want to borrow as much because you don't think you're going to need to do extra business. So he thinks they're getting the effect that they want, which is kind of an argument against the sentiment that you get from a lot of people on Wall Street that the Fed is not restrictive enough and that we're seeing the asset markets rise a lot because financial conditions are too easy.
Hey, Mike, when I think about the district of the Atlanta Fed, I think about one of those areas of the country that, boy, has been doing very well for a very long period of time, and particularly now, post-pandemic with some migration changes here. What are you hearing down there about just kind of the economic activity? How are consumers doing in that part of the world?
Well, President Bostic said that the people he talks to all over his district report that things are going pretty well for themselves. They have the same issues that we see in other parts of the country where they think the national economy isn't doing all that well. But in general, things are better. Now, it's a matter of degree because his district includes, obviously, the wealthy areas of Florida and Georgia and some of the less wealthy areas of Arkansas, of Alabama and Mississippi. They're different economies, and the other two, the latter two are much more agricultural, so they have an issue with other things besides interest rates. They have to worry about weather, et cetera, and they've had bad weather. But overall, people think that things are going fairly well in their own personal financial lives.
All right, Mike, thanks so much for joining us. Always appreciate that. Michael McKee, hard at work down at Amelia Island, Florida. We appreciate checking in here.
I'm sorry, he looks a little tan.
He looks a little tan.
A little for a radio audience.
And there might be a little pool time this afternoon.
Just put it out there.
Beach. They can do anything down there. It's very beautiful down there. All right, let's check in with Allison Williams. She covers the banks for Bloomberg Intelligence, and one of the big banks is JP Morgan, and they're having their investor day today. Allison, give us, what have you learned from our good friends at JPM today at their investor day?
So I think, the most important thing is they're keeping their long-term 17% target. And then sort of supporting that, they did up their net interest income guidance. We don't think that there's going to be much change to, I guess, the consensus, because I think consensus was already there. So they upped the guidance to reflect fewer cuts, but we already knew that. They also upped their expense guidance. Again, we knew that because they, have already flagged that they're going to have a gain from some Visa shares, and they're going to use some of that to pre-fund investment spending, some charitable contributions. And then finally, they did some math walking through capital. So Basel III Endgame is the big question. They looked like they would be short based on the last proposals that we got last July. But Powell has said that we're going to see big changes. And so JP Morgan did some scenario analysis around that, and they feel pretty comfortable, and they're starting to increase their buybacks, and there is a lot more to come if we do get some relief to that proposal.
Allison, the stock is down like 0.5%. Do I take away anything from that in terms of how investors perceive the numbers?
I mean, I would say that we didn't get any big positive surprises, so I think that's what the stock is, telling you. As I said, they upped their net interest income guidance, but consensus was already there. We already knew that there were less Fed rate cuts expected, and so they just kind of guided to that. And then, there were questions around their target, but they were so far above that last year. They're operating at such a high level. And again, consensus is already expecting them to beat that target this year. So nothing, I think, no real big surprises. I think the next, I guess, new news, if you will, that we will get are the stress tests in June, where JP Morgan said today they actually expect their stress buffer, their requirement to go up. So I think setting that guideline sets them up well to either, meet or surprise positively. And then when we do get those guidelines this summer on Basel III Endgame to see, what the big changes are and if we are going to get some of the relief that everyone basically expects after Powell has made those comments.
Alex, you mentioned the stock's down about 0.5% today, but intraday earlier this morning hit an all-time high.
Oh, fair enough.
It's unbelievable. $585 billion in market cap. Allison, just to refresh our memory, where are we in terms of our discussion of succession for Jamie Dimon? Is that even on the table anymore? Or where are we in that?
I think that, they're sending a more and more clear message today, having Dan Pinto sort of walk through some of the opening remarks. I think that, more and more that's really, they've sort of made clear the plan. Jamie has the running joke about the 5 years, although, more recently, it seems like he has talked about getting a little bit closer towards that goal. But I think really at these investor days, you see what a strong bench they have on display. We already heard, from Marianne Erdos, and we heard from Marianne Lake, who runs a consumer business. And really, I mean, the strength in these stories, there's so much positive going on. Just continuing to invest for growth, net inflows in the asset management business, building out branches in the consumer business. A lot of positive things going on in the business lines, and again, a strong bench.
Before I let you go, have we learned anything about investment banking, what the IPO looks like, what the M&A market looks like? We're still waiting for that turnaround moment. Any word on that?
So that's, I think, all coming up on the agenda. As I said, so far we really have just been focusing on the asset and wealth and the consumer side. But I think we'll definitely be digging into the details in that in the next few sessions.
Excellent. All right, Allison Williams, thank you so much. We really appreciate you stepping out and chatting with us. Allison Williams is Bloomberg Intelligence Senior U.S. Banks Analyst. She also covers basically anything that handles money. So she's very helpful. Asset manager, you name it. And this just in, we got some pictures from Mr. Michael McKee.
Yes.
To prove that he is in the conference, but his outdoor picture might say something a little different.
Yeah, it's kind of the indoor picture is where he is, and the outdoor picture, like beaches and pools and stuff like that, is where his boss thinks he is.
Yeah, or where he will be.
Yeah.
in the next
I still
few
see
minutes.
a drink with an umbrella in his hand somewhere in his future today.
Oh, yeah, it's happening. All right, coming up, we're going to talk to Edward Norton, co-founder of ZEC. Apparently, this is a company that aims to fix really boring board meetings. I've never been in a board meeting. Are they really boring?
They can be, but I mean,
is
if
that
you're...
B-O-R-E-D?
No,
Oh.
B-O-A-R-D. But thank you for clarifying.
No, I've pitched to a lot of boards, and I've argued M&A valuations to a lot of boards, and then they kick you out. But yeah, that could be, but we'll see.
Well, we're going to see. We're going to see how to make it more entertaining and more exciting. So we're going to have that coming up. That should be a lot of fun. This is Bloomberg. Happy Monday, everybody.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash, major stock averages adding to their records from last week. Investors gearing up for the earnings report for the poster child of artificial intelligence. We're going to get results from NVIDIA on Wednesday, and ahead of that, those shares right now, they're up 2.6%. The cruise lines among the best performing stocks right now in the S&P 500. This comes after Norwegian's profit outlook was raised for the second time in 3 weeks. Norwegian cruise line shares right now up close to 7%. And then you have, Carmen talked about this earlier, him and Hers Health saying it's offering a treatment with the same active ingredient as Wegovy for $199 a month. That, of course, undercuts Big Pharma by as much as 85%. Those shares were up about 31%. And then free checking may be obtainable only for the most affluent Americans. That's according to Marianne Lake, head of Consumer and Community Banking at J.P. Morgan Chase. Right now, S&P 500, 19 points higher, 53.22, record there. The Dow, 29 points higher, that's at 40,032, record there. The NASDAQ 100 right now up 118 points, a rise of 0.6%, record there for the NASDAQ 100 and the NASDAQ. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. That would be the internet, John. So you can go over to youtube.com, search Bloomberg Podcast. So, Alex, you asked if I've ever been in a board meeting. The answer is yes.
Okay.
My famous board meeting discussion is I literally got thrown out by a top 4 media mogul on the planet for valuing his satellite company at what he thought was half the price. We literally got thrown out, escorted out. He didn't pass our fee for like a year.
Wow.
And it was due like the day after.
Good job.
2
Nice
years
job.
later, sold it for half of what we valued it at.
Half of what you valued it at.
Yeah, so we were wrong, but we were high. But anyway, that was my getting thrown out.
Love
But
this story.
Our next guest describes participating in board meetings as a, quote, punch yourself in the face experience. I've experienced that. Edward Norton joins
Literally.
us. He's a co-founder of ZEC. He joins us live here in our Bloomberg Interactive Broker Studio. No mailing in for this guy. Edward, thank you so much for joining us. Really appreciate it. Talk to us about ZEC. What are you guys trying to do at ZEC?
Well, we're trying to make the experience between management of organizations, and I say that meaning corporations or nonprofits, because obviously we've got a couple million nonprofit organizations in this country that have governance and boards and stuff like that. We're trying to take what we feel is an increasingly toxic dynamic and reform it into being what it's supposed to be, which is a relationship that propels an organization, supports, brings additional leverage, positivity to an organization. And we, I've definitely had some people say to me, like, you have an interesting day job. Why would you get involved in a...
And your day job, just for folks that on the radio, Edward Norton, actor's been in a bunch of movies and all that kind of stuff.
Yeah. And I will admit that, on the surface, like a software platform for board governance features seems pretty esoteric, but it grew out of my own experiences over the last 30 years, not dissimilar to yours, from serving on the board of arts organizations, serving on conservation organization boards, and then as I built my own companies, and I've built a few software companies that we had our own boards, people like Fred Wilson from Union Square, or Axel or Greylock, or these firms. We were on the management side, and we were experiencing what it meant to have a board. And then when I sold one of my companies and I joined the board of GoFundMe, the company that acquired us, cool. I started sitting on corporate boards, and my partners and I really started feeling that there was this elephant in the room, which is that companies go through 4 to 8 times a year. They go pencils down to get ready for this thing that essentially to them feels like a hall monitoring moment. And board members, on the other hand, when I was a board member, 36 hours before the meeting, you get a 90-page PDF, and you're supposed to read it in the airport terminal, and then you go to the meeting and get it read back to you. You know what I mean? Right, like, there was just... And
so you're looking to make it a more, interactive, visual, engaging experience?
I think we say 2 things. One is, quantitatively, board meetings are an enormous waste of time for everybody, and that has to do with the amount of redundant time waste on setting these meetings up and the presentation materials, and that can be crushed down by having cloud-based, AI-powered tools that make it like 1/10 the time for a company. On ZEC, a company can set up for a board meeting in 1/10 the time that they were using to prep before it. Board members should get to read something that's, you wouldn't read the New York Times or Bloomberg on a PDF. You read it in a mobile-friendly scroll, right? That we expect that now, and so everything about the user interface should be easier for both sides of the table. But also think about this: think about how much time, how many professional, talented people with whose time is valuable sit there in board meetings approving minutes approvals, approving stock option packages, things that they ought to be able to do from the airport lounge in advance. So we built governance function that can be interactive and mobile and all of it.
So your customer is the board.
The customer is the company and the board. You know, but both sides, management and board members, suffer in different ways, and we've tried to reform it. But when you crush the redundant inefficiency of time waste, you improve the quality of the meeting too, because a board meeting should be a forward-looking experience, not a. You don't want to spend hours looking backward. Everybody can ingest the looking backward part before the meeting. You want the meeting to be propulsive and additive to where the company or the organization is trying to go. And the best thing about what people are saying to us is not just, oh, we really love the user interface, it's much easier, it's easier to read. We love that they're saying to us, this has radically improved the quality and the value of the meeting itself and what we're getting out of our board.
So you guys just raised about $7.5 million Series A, led by Salesforce Ventures, including some other guys as well. What are you gonna do with it? And what's sort of your end goal here?
Well, you know, I think if you look at, I mean, first of all, Salesforce to this day is still, I mean, they still are the greatest innovator in cloud-based corporate tools. And I've known Mark Benioff a long time, even though I never told him that we were doing this with his own team until it was done, because I didn't want to, you know, I didn't want it to come from the top down. The Salesforce team is really phenomenal. But, you know, our fantasy was to work with Salesforce because really nobody understands the business of cloud-based corporate tools better than they do. And I also like their ethos as a company. I think they have a great customer service ethos there. But, you know, if you look at, think about today, would you ever get a FedEx package with signature tabs on your legal documents? No, you get it in DocuSign now, right? You don't manage your cap table in Excel spreadsheets anymore. You use Carta, and we've made this evolution toward lots of aspects of corporate function have gone into the cloud, but this really critical function hasn't. And we think that on a business level, to be honest, if you look at, you know, Carta, which is a $7 billion private company, and DocuSign is a $15 billion public company, there's an enormous market in relatively low-priced corporate software tools, and we really thought this was a good business. We think there's a very large marketplace of companies and nonprofit orgs that need to reform this critical piece.
Where are you in the evolution of the company? Have you signed up clients now?
Oh yeah, we're into the thousands of companies and nonprofit orgs who are our customers.
Interesting, like Fortune 500 companies. What size companies?
Yeah, well, actually, it's funny you say that. We are just in the process of clearing what they call the SOC 2 software security process, and that lets you be a platform for public. We actually have a number of large public companies using it, but we have been mostly for smaller and mid-sized private companies until we clear this critical kind of security.
Do you guys have an end goal here? Because I know with your previous company, CrowdRise, right? That was sold to GoFundMe.
Yeah.
With the same co-founders. Is this the same roadmap for you guys here?
Yeah, you know, I think that we've been totally focused on the product to date, making sure that it really, really works and really gets the kind of response that it's getting. So essentially, we went to Salesforce and said, here's how it works. They loved it, and we said, how do we now sell this? You know, how do we now grow this as a business? And you know, even when we present it like Salesforce's Dreamforce and things, you're talking to a constituency of many tens of thousands of companies. And that's our agenda now. Is we kind of did it in stealth, and as we're doing here with you, we're kind of coming up and out.
And is it a subscription model?
Yeah. Okay. It's for any company. For any company that it's incredibly familiar, and if you subscribe to DocuSign, if you subscribe to Carta, you're talking sub $10,000 a year type subscriptions these tools, and that's why we think, because it has to work for a nonprofit org. It has to work for a small startup company. We're not talking about $100,000 a year enterprise software contracts. We're literally talking under $10,000 a year.
All right. Interesting stuff. Thanks for stopping in. Really
Absolutely,
appreciate it. Edward Norton, he's a co-founder of ZEC. He's also got an acting career, from what I understand, so he's kind of busy out there doing it there. Kind of, again, bringing. I bet you the pandemic accelerated a lot of that stuff. Like
It's such a good point.
DocuSign and all that stuff.
I don't do anything on a PDF.
Oh.
PDFs are dumb on my phone. Like, of course you're going to want an app.
But you still go to a
through
restaurant and you give them the credit card. They go somewhere. They do it all. They bring you back 17. Whereas you go to, when I'm in Europe somewhere, the little person comes up and puts it all.
The little person comes up and puts on the thing?
I don't know how it works, but the technology.
Who's serving you in Europe?
Is everywhere.
Little people, apparently.
With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, and John. Court is back in session in New York for former President Trump's hush money trial. Today, his former attorney, Michael Cohen, is back on the stand. Before court started, Trump once again called the trial politically motivated.
We have tyranny right now. We have tyranny right now, and we're disgracing our New York court system. And we're really disgracing our country, because all over the world they're watching.
Judge Juan Marchand said the trial will wrap up after the Memorial Day holiday break. Iran's President Ibrahim Raisi, widely seen as a candidate to become the country's next supreme leader, was killed in a helicopter crash on Sunday. His death, along with Iran's foreign minister, was announced by state media after rescuers spent hours trying to locate and reach the accident site of a mountainous part of northwestern Iran. U.S. aid to Ukraine will be flowing in week after week. That promise today from Defense Secretary Lloyd Austin during a virtual meeting of the 56-nation Ukraine Defense Contract Group.
More assistance is on the way. That includes additional munitions for NASAMS and Patriot air defense systems, more HIMARS systems and ammunition, Stinger anti-aircraft missiles, and Javelin and AT-4 anti-armor systems.
Secretary Austin says the group has collectively committed more than $95 billion in security assistance to Ukraine since the start of the invasion in 2022. Xander Schauffele captured his first major championship Sunday at the PGA Championship at Valhalla Golf Club. Schauffele spoke about being proud of the way he handled moments on the course differently than he did in the past.
This is awesome. It's super sweet, but when I break it down, I'm really just proud of how I handled certain moments on the course today, different from the past.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the newsroom with this Bloomberg Business Flash. Just a few days ahead of the results from NVIDIA, major stock averages surpassing their record closes from last week. NVIDIA, on its own, that's been responsible for 1/4 of the gains that we've seen in the S&P 500. U.S. stocks, by the way, the reset here, on a $12 trillion rally since late October. J.P. Morgan Chase & Company raising its forecast for net interest income. And shares of J.P. Morgan Chase with their investor day up down right now, down 0.7%. Despite the records for the major stock averages, Stu Kaiser at Citigroup says there is no shortage of investor anxiety at this point.
A lot of it, to me, revolves around the labor market. I think that's the area that is by far the biggest risk to equity markets. And if you look at the KC Fed labor tracker or other metrics, there are some sort of cracks or little weeds kind of in the garden that you need to deal with, and they just kind of keep people a little bit conservative. One
of Wall Street's most prominent bears turning positive on the outlook for stocks. Morgan Stanley's Mike Wilson now sees the S&P 500 rising 2% by June 2025. That's a turnabout from his view that the benchmark would tumble 15% by December. S&P 500 right now 18 points higher, up 0.4%. We're at 53.22 on the index. The Dow Jones Industrial Average up 52 points, up 0.1%, 40,060. And the NASDAQ 100 right now 120 points higher. That is up 0.7%. Again, records all around. And we're brought to you by IBKR Financial Advisors. Switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests at ibkr.com/RIA. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
John Tucker, thank you so much. Happy Monday. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in finance and economics through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide. We also take you outside Bloomberg Intelligence and get a look at under the hood and on the street and saying, hey, what are you doing with your money? It is very clear that we're in an everything rally when it comes to metals and when it comes to the equity market. As John Tucker was just saying, adding $12 trillion in value since the S&P bottom back in October. So what's going to disrupt that? I honestly don't have a good answer, but maybe Dana Dioria does. Co-Chief Investment Officer over at InvestNet is standing by. Dana, what stops it?
Hi, thank you for having me. Well, yeah, I mean, we've definitely sort of skidded over to this idea that, the resilience is the name of the game. The markets are doing well. We're seeing breadth. It's not just, obviously the Magnificent Seven. But there are definitely cracks that could potentially widen and become more of an issue. And one of them, of course, at a high level is just the election coming up and the volatility that's going to be coming into markets as a result of that. I think as the election season heats up, and that's not to say, one winner versus another, there will be definite winners and losers based on how the election pans out. But I think as we head into the election, expect more volatility in markets. And then, of course, jobs, employment obviously is a big one. We're not seeing any real cracks there, but if there were to be, that would be an issue. And growth obviously came in this, last quarter a little lower than expected as well.
Dana, it seems like some of this recent move we've seen off that April kind of weakness was maybe driven by good old-fashioned earnings. What did you take away from the most recent earnings cycle? And again, we have another big name reporting Wednesday after the close with NVIDIA.
Yeah, I mean, earnings has been what's been propping up the economy, right, alongside employment. I think the fact that, we haven't seen the weakness yet on the corporate side. We have seen productivity kind of holding steady. Now, that being said, you know, the market to a large extent, I would say, has been sort of priced for an expectation. So, you know, individually, when you see anybody kind of coming in not at, you know, exactly where it needs to be or beating, you know, they kind of get punished. And I expect that would continue, you know, into next quarter as well. But yeah, earnings have definitely buoyed us for, you know, not even just this last quarter, but in general, if you look back to 2023.
Right, which makes it so hard to then sell, because if you take a look at, say, the EA function on the Bloomberg terminal, and you look at earnings and sales growth year on year, quarter on quarter over the next year, it just keeps going up. So it's hard for me to then find the reason to then sell. How do you look at the next 4 quarters?
Yeah, so one of the things I would differentiate, of course, is, you know, size of companies, interest rate, you know, how dependent is that company on going to capital markets, for example. In an environment of higher for longer, for example, small caps tend to be, you know, more interest rate sensitive. If you're going to look individually, just who's able to self-fund versus not. So in an environment that's higher for longer, and as corporate debt starts rolling over, I do think that's one area for, you know, as we're talking about it, to say, okay, this is a place where weakness can come in on the corporate side, because these companies do have to return to capital markets and roll over debt at higher rates than they've needed to in the past, higher rates than, you know, they've needed to in a decade, right? So I do think that's one thing. Now, that being said, I am a proponent of small caps. I just think you have to be able to buy in and hold on, because I think the market has priced in that scenario for them.
Dana, in the fixed income side, how much risk are you suggesting people take? Because we can sit in a 2-year treasury and get 4.83% today. How much credit risk should I be taking out there?
Yeah, I mean, you know, it's a funny thing, right? Suddenly you're getting paid, whereas you weren't for a long time in the fixed income space, and you really don't need to extend that credit. So coming from, you know, a platform that services retail advisors and clients, for a long time, you know, we saw sort of just a stretching on the fixed income side. If you look at that standard 60-40, taking that 40% and really stretching what could be called, you know, a fixed income position, right? A traditional ballast position in that portfolio, by pushing into higher and higher, you know, higher yielding, you know, leverage loans, even to an extent dividend payers, because you were looking for some return on that. We're not in that environment anymore. And for the standard investor, I agree with the premise of your question that, yes, it's not to say you should take credit risk, but you don't have the need anymore that you did, you know, in a period of financial repression, to really move out on the credit risk, to be putting in, you know, perhaps, you know, areas in fixed income on a different place in the capital structure, and areas that are, you know, just higher yielding, but also bringing more risk to the portfolio when you already have that big equity stake.
So you said you like small caps, but you got to kind of stomach it. Why do you like small caps?
Yeah, look, I mean, small caps, and if you excise the growthiest, you know, least profitable small caps, which are more like a lotto ticket type payoff structure, then you're living in a world where, you know, they have outperformed over time. Small value in particular has tended to not only outperform, but also to outpace inflation. And so if you look at the standard portfolio that most people are sitting in, they have a ton of the big growth, just by virtue of the fact that if they're not indexers, you know, the active managers are not going to stray that far. They can't stray that far to take on that much tracking error. So small caps are a nice diversifier that have paid off over time. Again, if you take out those really low profitability stocks, and that's what you see a lot too around, you know, buy quality small caps, buy the 600, right? Because you can get that diversification benefit, that long run return potential, especially now that there's a cost of capital again, you know, and some of the fundamentals can be reasserting in these, you know, style factors, for example, in these portfolios.
All right, Dana, thanks a lot. Super appreciated Dana Dioria joining us, Co-Chief Investment Officer over at InvestNet, joining us from Connecticut. it just feels like it's going to be really hard to change the narrative at this point. I mean, maybe NVIDIA does something, but...
Yeah, maybe NVIDIA does something.
Yeah.
Maybe we hear from the Fed that, you know, I don't know. We hear from the Fed so often, but what could they say at the next meeting that would freak people out? I think the market, they kind of conditioned the market to saying, hey, we're going to hang here for a little bit, but on the margin, we're going to be cutting more likely than not at some point this year. I think that in and of itself, the anticipation of a cut, to me, is almost as good as the cut itself.
Totally, and that's what Mike McKee was saying to Raphael Bostic. He was like, I know you guys don't want to do forward guidance, but aren't you kind of doing forward guidance by doing all that? Because the market front runs you, and he obviously sidestepped that, but nonetheless. Coming up, we're going to talk about red lobster and some shrimp.
Yep.
We're going to drill down into that. There's an index.
Company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at your company news. Let's start with this one because we're going to go on more in depth a little later. Seafood restaurant. You saw this one coming. Red Lobster filing for bankruptcy, succumbing to onerous leases, high labor costs, and yes, that disastrous all-you-can-eat shrimp promotion. The Orlando, Florida-based company filing for Chapter 11 yesterday. So the assets and liabilities, $1 billion of assets, up to $10 billion of liability. This filing, though, allows the company to keep operating while it works out a plan to repay creditors. They were founded back in Lakeland, Florida in 1968, expanding rapidly in the 70s and 80s, and developing a loyal following for the Cheddar Bay biscuits. Jeff Bezos' Blue Origin, I'm really getting hungry now. Blue Origin resuming sending tourists to space on Sunday, launching 6 private passengers on a short flight of more than 60 miles above the Earth. Does that qualify for space? The passengers include Ed Dwight, former Air Force captain who was selected as the first black astronaut candidate back in 1961, but never got to fly to space with NASA. This flight, Blue Origin's first tourist mission on New Shepard since August 2022. The company was forced to halt flights of the rocket after a New Shepard vehicle suffered an engine failure mid-flight. Sour Patch Kids Oreos, vanilla cream-filled cookies speckled with colorful bites of the sour candies, one of about a dozen limited edition Oreo flavors that Mondelez plans to release this year. The branding experts say when companies combine brands, they're trying to build an association in consumers' minds. Association with getting sick, I guess? I don't know. Anyway, that is your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
This is Monday. Yes, it is. Monday. Happy Monday, guys. You made it. I'm Alex Steele, alongside Paul Sweeney and John Tucker. John Tucker and I just realized that we frequent or have frequented the same beach club in the Jersey Shore. This is exciting. We're going to talk about this in just a moment.
What were you, like, hiding?
What do you mean hiding?
I didn't see you there.
Well, okay. That was like 25 years ago.
Now that you know I go there, it's like not, it's... You're not gonna go there anymore, are you?
Well, I don't go there anymore since my grandmother died, but we went there a lot. Okay. They had a really nice the bakery area. We had those crumb muffins. Anyway, this is the moment. Anywho, this Monday, we're Bloomberg Intelligence Radio. We not only bring you Beach Club news, but we also bring you news from world and national news with Michael Barr. Michael, save us from this conversation.
Thank you very much, Alex, Paul, John. Iran's Supreme Leader Ayatollah Ali Khamenei has ordered 5 days of mourning and named Vice President Mohammad Mokhber as interim president following the helicopter crash death of President Ibrahim Raisi. Bloomberg Middle East anchor Jumana Bersetchi has more on what comes next for Iran's leadership.
Ultimately, the decision maker in the country and the ultimate power still lies with the Ayatollah, with the supreme leader. He was quick to put out a statement yesterday saying that there will be no disruption in the country's affairs, even if it is confirmed that the president has died. He put that statement out yesterday, and of course, it did emerge that the president was killed.
Bloomberg's Jumana Bersetchi in Dubai. Right now, attorneys for Donald Trump are cross-examining the former president's attorney, Michael Cohen, in a Manhattan court. It comes as the judge in Trump's hush money trial pushed back closing arguments until a week from tomorrow because of the Memorial Day holiday. There has been a lot of speculation over who Donald Trump will pick as his running mate in his bid for the White House. One name that has emerged as a possible vice presidential pick is Republican Senator Katie Britt of Alabama. Britt was asked if she would accept the post if offered.
I am sure he has a long list, many of which are our colleagues, and we're rooting for them for sure. Bottom line is we're going to all do everything that we can to get Donald Trump back in the White House and also take back the Senate, because the fate of our nation is at stake, and we believe that that's worth fighting for. Republican
Senator Katie Britt of Alabama speaking with Bloomberg's Anne-Marie Hornern. In London, WikiLeaks founder Julian Assange has won a court victory in his fight to resist extradition to the U.S. He will be allowed to appeal. Assange's wife, Stella, appeared outside court.
This case is shameful, and it is taking an enormous toll on Julian. Drop this case now. Now is the moment to do it.
The WikiLeaks documents were released almost 15 years ago. Global news 24 hours a day and whenever you want it.